is why it is not only the Indian IT companies. That is why a JP Morgan or a insurance companies or the Amazons of this world apply for H1B visas. So if you want to hurt yourself, or if you want to make your cost of production higher, if you want to make your cost of technology higher, I mean, honestly, yes, I mean, anybody can do whatever act they want to do. But in general, I think Indian IT industry has reached a level of sophistication, level of thought leadership, a level of maturity that a step back will not hurt anyone. I'm talking of all the companies which already have enough H1s in the circulation, and hence they can manage with their own H1s and hence be able to support the client without getting into any kind of a panic.
Mr. Gurnani, well-articulated thoughts on this particular issue, and the companies do have 6 months to come out with mitigating factors. But as Mr. Gurnani pointed out, and he's been a veteran of the Indian IT industry for now more than 2 decades, he points out that it's not going to be very disruptive. Thank you very much, sir, for joining in. And someone called it a self-goal because of the kind of dependence that big tech, consulting firms like Accenture, Deloitte, E&Y have on H1B visas. So 70% of the H1B visas go to Indians.
Yes.
But a majority of that is actually by big tech firms like Amazon, Meta, Microsoft and consulting firms. So someone called it a self-goal. Just echoing the point. Yeah, just echoing
Absolutely.
the point.
And I like the point that Mr. Gurnani made as well, right? It could actually make Indian companies more competitive. And in fact, offshoring could get a bit of a booster shot as well. So interesting times. Well, let's move on then. Let's get our research team, all of them, coming up on the screen for you, because we're going straight to our CNBC TV18 list of top stocks that we're looking at. And Rima, you start off the proceedings.
So far all the people we've spoken to said that yes, it's going to maybe hurt in the near term, but in the long term, I think the impact is going to be manageable. So it'll be interesting to see the kind of reaction. But just in the near term, I think there is some fear. Look at the way Infosys, Wipro, ADR performed. They were down between 2 to 3%. BofA says that, if there are no mitigating factors, if the companies do not take steps as is, there could be an impact of 2 to 6% on an annual basis. But the companies can take steps to offset that. So over a 3-year period, they don't see any impact. But Tech Mahindra is a stock that they believe could be impacted. CLSA also says that it will have a limited impact. If the entire burden on fresh applications, the companies do not reduce the number of people they send on H1 visas, if you assume ceteris paribus, the impact will be about 6%, but the actual impact should be a lot lower. In their coverage, LTI, Mindtree and Persistent Systems will see the highest impact. For TCS, it could be lower. But just let's put out the numbers that midcap IT companies have said. First Source, no impact. Coforge, only 63 H1B applicants were approved last year. Cyient, 6. Emphasis 130, and Persistent hasn't given a number, but they've said the impact is going to be it's not going to be material. So near term, yes, this is a bit of a disruption, but it seems to be that it's manageable and it's not an existential crisis for Indian IT.
Got it. Thanks a lot for that, Rima. Well, let's hop across to Vivek. He's here to tell us about a few more stocks that he's tracking. Good morning, Vivek.
Well, good morning. A few power as well as infra companies in focus. Routine order wins across most of these names. So Power Grid has won and has emerged as a successful bidder under the tariff-based competitive bidding. Now, this is for setting up an ISTS project, and this is in the state of Madhya Pradesh. This particular project will be done via the build, own, operate, transfer mechanism. Seagull is the other stock on focus. The company has emerged as the lowest bidder. Now, this is for setting up a BESS or a battery energy storage project in the state of Madhya Pradesh. This is for a solar PV project. The construction period is for 24 months. The total PPA will be signed for 25 years. The tariff is at 2.7 rupees per kilowatt hour, and the total approximate project value is at close to 1,700 crores. So positive development as far as Seagull is concerned. PNC Insa will also be in focus. This is on the back of the fact that the company has received the letter of acceptance. This is from the Bihar State Road Development Corporation. This particular order is for the construction of a bridge, contract worth 3 years, and the total size of the contract is a little over 495 crores. And lastly, NBCC, a routine order win across 4 states. The company has received orders worth 117 crore. This is from UP, Haryana, Gujarat, as well as New Delhi.
Thank you very much for that. Let's get to some other stocks. Netweb will be interesting. They won an order, 450 crore rupees. Vinny is now joining in with more on that. And she's also watching some pharma stocks.
Hi Rima, good morning. So Netweb Technologies, we've seen a run-up coming in the last month specifically. There was a big order win that came in last month. Now this is another big one, 450 crore order win. This is from Tyron AI GPU accelerated system. Now this is obviously for deployment of AI infrastructure facility. Time period of completion is going to be by the end of FY26. So that will be interesting to watch out for. In terms of Netweb Technologies, we're expecting green here. Lupin, that's the one that we are expecting a bit of a subdued performance today. Red is what we could see. US FDA inspection has been completed at its Pune biotech facility. 4 observations is what they've received over there, and the company said obviously they will be working with the US FDA and will give their responses. But as of now, we could see red here. Lastly, Aarti Pharma Labs, that's the one we'll focus on. The company's promoter has sold 0.66% stake in the company, Sefchem Enterprises. They have sold 6 lakh shares. So that's the promoter company. Now, apart from that, we've seen buying coming in of around 1.7% stake overall from Norges Bank as well as Vanguard. So we could see green coming in here for the company.
Okay, all right, Vinny. Thanks a lot for that. Well, let's go to Ria then. She's here to tell us about Garden Reach as well as GNFC. Morning, Ria.
Well, good morning, Nigel. First, let's focus on Garden Reach Shipbuilders. They have signed a $62 million agreement for the construction of 4 units of hybrid multi-purpose vessels. These orders have come in from 2 German companies and are going to be executed within the next 33 to 42 months. They also have a provision of 2 additional vessels of the hybrid propulsion type. And remember, the company had also earlier signed contracts for a total of 8 other vessels under the MPV program. And apart from this, for Garden Reach, they've also signed 5 MOUs with strategic partners in the shipbuilding, port and infrastructure sectors. So positive start expected for Garden Reach. Moving on to GNFC, this one expected to open in the red since the TD2 unit at the Dahej unit has been shut down due to a leakage. The company has clarified that the incident remained confined within the company's premises and there was no loss of life and no gas release beyond the plant boundary. This TD2 plant will be restored after the completion of the necessary checks and the remedial measures once they will be completed.
Thank you very much for that. Let's do a quick recap then of the top stocks. Stocks with positive news flow are Power Grid, Seagull, PNC Infratech, NBCC, Netweb Technology, Aarti Pharma, Garden Reach Shipbuilders. Stock with negative news flow are broadly watch for all the IT stocks, Lupin and GNFC. Moving on now, let's get a handle on what's happening in the world of commodities and currencies. Manisha is now joining in for a complete roundup. Manisha.
Thank you so much for that. Well, I'll start with the crude oil prices, where we have started the day with a gain here. Geopolitical tensions in Europe and Middle East really seem to be supporting. The Russian airstrikes at the West Ukraine are threatening the Polish border, and that is where the premium really seems to be building in. But apart from that, you also have a 19th package of sanctions from European Union coming in on Russia. There also is a tropical storm by the name of Gabriel brewing up in the Atlantic Ocean. So there are various things right now which seem to be supporting the crude oil prices. Having said that, the precious metals also have surged back yet again. Friday was a day of profit taking, but today morning you're looking at the gold prices just about $10 away from making yet another all-time highs. Silver is at a new 14-year highs with $43 an ounce onto that one. What the markets will watch out for in this week is going to be about the U.S. inflation data, and 9 Fed official speeches are slated for this week. That is where you'll get your cues from.
Okay, all right, Manisha. Thanks a lot for that. Well, time to slip into a short break. On the other side, Dharmesh Kant of Chola Securities will be joining in to help us out with some fundamental stock talk. Stay with us.
whatsoever. So I think you have noticed it that Indian companies' dependence on H1B has reduced by almost 60% over the last 5 years, and we can do with much, much lesser. And I don't think this will disrupt the Indian IT industry. As a matter of fact, I see it as a positive. Positive number one is we will do more offshoring, there will be more GCCs, and there will be more automation. Number two is that Indian IT industry will shift towards products and platforms to reduce the dependence on some of these programs like H1B even more. So I see only the positives, and temporarily also this is not a setback.
All right. Hi, Mr. Gurnani, and thanks a lot for joining in, sir. Do you think, but higher offshoring, they could look at higher offshoring, but could it attract further scrutiny from the administration out there, and it could actually make things difficult?
I mean, listen, if you want to hurt yourself, that means if an American administration wants to hurt themselves, let's face it, there is not enough skilled STEM workers in United States. And that is why it is not only the Indian IT companies. That is why a JP Morgan or insurance companies or the Amazons of this world apply for H1B visas. So
Into Bazaar Morning Call, and hope you're having a pleasant morning. Well, Dharmesh Kant, Head Research at Chola Securities, joins us on the show. Hey Dharmesh, good morning. Good to see you in. Well, we've spoken plenty about tech from the morning because of this H1B visa issues that could hurt a lot of Indians. But let's keep that aside for now. Let's focus on other stocks. GST 2.0 is here with us, and it could drive a big consumption boost. And probably the next 1 month or 45 days or so is going to be very, very interesting because of a whole host of measures and GST 2.0 at the helm. Tell us, how do you approach autos, cement, some of those potential beneficiaries of the GST cut? I recall you telling us you're bullish on Hero MotoCorp as well as Mahindra & Mahindra in the past.
Yeah, very good morning, Nigel, and thanks for inviting me for the show. Now the time has come when the rolling will get going as far as the consumption drive is concerned. Government has did everything. I mean, whether it is GST cut, indirect tax cut, direct tax cut, and the interest rate cut, everything has been playing out. And there has been appeal by the government as well to boost up the consumption since savings are there in your pocket. So it has to be seen how the consumption pans out. But our dealer checks suggest across Pan India, there has been a good query and people have been inquiring about when this will be rolled out or how much the differential in the pricing will be. We think this is definitely, it will play out in the next 30-45 days. Though automobile stock prices have run up quite hard. I mean, Hero MotoCorp have run up 20-25% from the time we have discussed about this, and we have been bullish far earlier than that. Same has been the case with M&M. But I do think as incremental news flow with regard to sales picking up trickles down in, there would be momentum in the stocks and they will keep on riding higher. So 10-15% on the very aggressive side, upside can still be there, depending upon how the incremental sales are. And people who are invested, I mean, part profit taking is always recommended, but you can still continue the ride for another 5-10%. That is how we are looking at the automobile space, and the top two picks still remains Hero MotoCorp along with Mahindra & Mahindra. Though Eicher Motors, TVS Motor, Maruti, Tata Motors always is likely to see a good upside. At the same time, cement side, as you have rightly pointed out, but I think there would be some tepid kind of action on the cement space, primarily because if you look at the cement prices net of discount, nothing has materially changed on that price. So the off-take price, the landed price for trade and non-trade sales still remains the same. Volume is what people are looking forward to, but that has to be seen. Again, 5-7% kind of an upside can still be there. And again, the top two picks, they are Ultratech and Ambuja Cement. We are looking at large cap cement companies having a pan-India presence and not going by the mid and small cap. However, I mean, consolidation can still be there in the play. So that is how we are looking at consumption space. Not particularly bullish on the FMCG basket per se. I mean, how much you can consume. You cannot consume two toothpaste at the same time. So that is how we are looking at that space.
So Dharmesh, give us 2-3 stocks where you see a lot of upside. As you said, in the case of in the case of auto names, they've already done so well, and the upside could be what, 5-10%, and periodically you are recommending profit booking. So just 2-3 recommendations from you where there is still a lot of value left in the stock, and there could be meaningful upsides.
I think, Rima, one has to look at financials. That is one space where rally has not picked up. And if we are buying the thesis that all this macroeconomic play, leads to consumption, longevity, and the drifting of the consumption into the month of November, December, then I think, 2-3 large cap stocks would be, one is from the private sector banking space. ICICI Bank and Axis Bank is looking solid to us. Similarly, from the public sector banking space, Bank of India. So these are from the banking space. NBFC, as Nigel pointed out, cement can pick up. So we are playing the real estate scheme through, NBFC space or housing finance companies. There, I think PNB Housing Finance has taken a strong betting, and that was nothing fundamental to do with it. So business is continuing as usual. So that can be in the recurring along with LIC Housing Finance, Aadhaar Housing Finance, R3 basket. So, the idea is go by a basket approach rather than a single stocks approach. And there a mix of, private banks along with, housing finance companies augurs well. As far as consumption pure play on the NBFC like Bajaj Finance and all is there, I think there won't be much traction out there. Much has been priced in. So there may be 2-3% kind of an upside, but then it's trickled down. But our long-term medium play definitely sits in the housing finance companies.
Yeah. Dharmesh, good morning. On Friday, there was that Supreme Court matter with regards to Vodafone Idea. And we got perspective from senior lawyers, etc., who told us that there is a change in stance, softening of stance from the government of India. This is now scheduled for the 26th of September now, where the government is expected to take a proposal to kind of sort of try to resolve this. We don't know what shape, form, etc. Vodafone Idea went up. Indus was up a little bit on Friday. Your thoughts?
Yeah, good morning, Bashar. This kind of rhetoric we have listened n number of times in the past 2-3 years, where government is, softening its stance, and they have already done their bit. They have done a lot of equity infusion. So it solely rests on the EGR part. If that has to be done away. Otherwise, on the operating level, if you look at Vodafone Idea, despite, subscriber base getting reduced, they are doing fairly well on the operating profit front. And if some lease of life is given to them, then definitely the things are in place and they can consolidate and take it forward from there. But unless this comes through, the bleeding is excessive. Look at the kind of a debt which is setting out there. So just servicing of the interest component is unbearable. And at this point in time, if the bleeding continues for next 6 to 9 months, then I think nothing will be left to be undone. So we are hoping that things turn around. But unless something comes through, it's difficult to take a long-term investment bet. Trading bets based on news flows can always be there.
Dharmesh, what about Netweb? It's one of those few IT-related stocks which are close to its 52-week highs, I think 1% away. And its low in April was 1250, and now the stock is at 3200. That's a 160% jump. That's the kind of buying interest at lower levels. Now, I know the stock is expensive, but I was just looking at the growth numbers. In FY25, top line growth 59%, FY24 63%, FY23 80%, the year prior 73%. So even though it's expensive, it's delivering on growth. How do you feel about this particular stock?
Yeah, sure, Neva. This is a unique proposition in the hardware side of the entire data center and the cloud built up out there. And they have done exceptionally well as far as, building up of the hardware side of the technology is concerned. So this is another classic example of services through hardware rather than software platform. So the company has done well and is likely to do well. Still, it's a far cry from a $1 billion mark of revenue. And I do think the way it is going and the way the evolution is happening across the space, and a lot of data centers would be required in India to match up to the global standards. And the domestic data use itself. So, I mean, 2-3% is what is there as of now compared to the data generation and storage of around 20%. So, a lot of gap there. So, people are buying that idea. I mean, if you are not looking at valuation per se on the multiple side at 100 PE multiple or say 110 PE multiple 1 year, 2 year forward, and just looking at the growth trajectory and the potential which is there in the system, and they have early mover advantage as well. The proof of the pudding has already been established about the capabilities. So stay invested. I mean, and just be there for 3-5 years. I think there are further upsides left to this company.
We had on Friday on Editors Roundtable.
Hiren Ved.
Hiren Ved, who we discussed Netweb quite extensively, right? So yeah, expensive, but
It's delivering like very good growth.
Fantastic growth coming through there. I think we have to take a break, so let's do that. Dharmesh, of course, is still with us. We'll come back in just a bit from now, get you some technical trading ideas as well. Coming up on the other side, Sudarshan and Nitesh. Welcome back. There's about 10 minutes to go for the market pre-open session. And let's get to the brokerage calls of the day in terms of what the street is watching out for. Sud is here with that list. So good morning.
Morning, Prashant. So first one on the list is Vodafone Idea. On Friday, we saw that Supreme Court has agreed to hear Vodafone Idea's plea related to AGR dues, and even government's reply was looked like it's looking to resolve this issue, and it has said that it's not opposing Vodafone Idea's plea. And today, Citi has come out with a note. It is a buy call, but mentions that it's a high risk, and target price has given is of rupees 10 per share. On Friday, also the stock had moved as high as 10%. Another stock might be in focus is Knowledge Realty Trust. Two brokerages have initiated coverage on the stock. First one is Morgan Stanley. It has initiated coverage with overweight call, and target has given is of rupees 122 per share. It says company offers a defensive profile on steadily rising cash flows, and there is a potential on acquisition front as well. And it's a strong GCC-led office. There also demand is expected to improve further going ahead. Second, even BofA Securities has initiated coverage with a buy call, and target is of rupees 110 per share. Some of the key features that it has mentioned: first one is most geographically diverse company. Second, it has a high exposure to GCC and has a low exposure to IT services. It has a healthy balance sheet with 20% leverage, and also it's sponsored by Blackstone and Satwa. And recently, SEBI has also mentioned that it will grant equity status to REITs, and which is likely to widen the investor base. That also might be positive for Knowledge Realty Trust.
Thank you very much for that. When we had chatted with the management of Knowledge Realty Trust during the IPO, they said that we hope to return mid-teens growth to our revenues. So mid-teens. And he said this will come by a combination of 7 to 8% dividend yield, and plus the balance will be on account of an increase in their operating cash flows, because many of their office spaces are coming up for rent renewal. And they're coming up in marquee areas like BKC. So the expected rent increase is going to drive a jump in their operating inflows. And as Sudarshan pointed out, there is that headroom post the IPO for acquisition. So mid-teens revenue growth is what the company was targeting to return to the investors over the just near term, 2 to 3 years next. But let's get in the handle on the market technicals. Sudarshan Sukhani and Mitesh Thakkar are now joining in. Gentlemen, good morning. Happy Monday to you. So Friday was a bit of a down day, and today the Gift Nifty is also suggesting a downtick. What should the approach be? Sudarshan, if you may go first.
Good morning. See, the approach, despite the fact of news and say a disappointing weekend for most Indians, I think the trend is still up. My view was that 25,200 is the cutoff point below which we should close long positions. That number remains. So far as the Nifty maintains its level, head above this level, I would be a buyer on dips. And actually today's early morning gap down, if it happens, hopefully, is a buying opportunity, because we already know where our stops are. So I would be a buyer on a dip.
Okay, will be a buyer on dip. Got that, Sudarshan. Good morning, gentlemen, and good to see you all in on this Monday morning. Mitesh, what's your view? The Gift Nifty is suggesting we pull back a little bit. We had some red on the screen on Friday. So put that together, you're getting 150, 180 point downtick. How do you approach trade?
Good morning, Nigel. So I think, we did have a negative day on Friday, and the closing was around 25,330, and a 70-80 point kind of gap down would imply that we might open around 25,250. Now, that is where the gap area is. That is where the first support for me kind of comes in. If we open around 25,250, 270 zones, and if there is lack of follow through, my idea would be to buy the dip immediately. As Sudarshan also mentioned, the trend is on the upside. You will have these kind of pullbacks and profit booking kind of, marginal declines. But around 25,250, if there's stability, I would immediately want to buy into it. In case we see the markets continue with the supply, then I think the next support level, which is around 25,150, kicks in, and that's where I don't think that Nifty is going to break below that level in the short term, and therefore that will be an even better buying opportunity. But the initial idea is that we might not see 25,250 itself break, it might sustain, and therefore the morning dip would be a welcome buying opportunity.
Gentlemen, Mitesh, morning to you. Sudarshan, morning to you. In terms of individual trades, Mitesh, what would you go with?
I have a mix of buy and sell, Prashant. On the stock side, there are some stocks, which are showing signs of correction. So I have some sell calls as well. But the broader idea is to be more on the long side. I have a buy on Bharti Airtel, a good swing breakout over here. The price are making a fresh swing high above the earlier highs of 1940.50. So keep a stop below 1940. Look for a first target of around 2000. Also a buy on Hudco, which had a very strong price volume breakout on Friday. So on a mild decline, say if you get it a point and a half lower, around 228 to 27, buy with a stop at 223 for a first target of around 238 to about 240. The FMCG names surprisingly look, they might have some more corrections. So I have a negative call on HUL, which I would recommend selling with a stop at 2590 for targets of around 2500. And Page Industries, the structure is negative. The stock is trading at a support of 43,500, just about 70 points higher. So if it breaks 43,500, take a shot with a stop at 44,100 and look for a target of around 42,300.
Got that. Buy Bharti, Hutco, sell Page and HUL. Sudarshan, you were telling us buy the dips today. If IT opens gap down, and it's likely to do so, what would the trade be on the Nifty IT index or any individual tech stocks? And then tell us your stock recommendations for the day.
It's a very good question, and I'll answer that with one of my stock recommendations. My big, bold recommendation is to buy TCS. I'm giving an initial stop of 3,000, although that would depend on how the market opens. And when you want to buy IT stocks or even the Nifty, there's no need to jump into the IT stocks. Once they stabilize, they are a buying opportunity. TCS is a buy simply because it has been moving sideways, building a base for 1.5 months. I think a dip would actually be a test of its earlier low and probably successful. So my view on IT stocks is to go and buy them. For the other three stocks that I have, all of them are buying ideas, and a dip is usually, we always say buy the dip. When the dip comes, we all get that fright. Who knows what will happen? So JSL is a buy with a stop under 772. Minda is a buy with a stop under 1300, and Torrent Pharma is a buy with a stop under 3560.
Okay, all right. Thanks a lot for that, gentlemen. We'll come back to you all for your 9:10 call. For the time being, we'll take that short break, come back, we'll get the pre-open rates. We'll also have Manik Taneja of Axis Capital who will be joining in to discuss the key trends in the IT sector and also give us his sense on the impact of the new H1B Visa fee. A pleasant morning. Well, Dharmesh Kant, Head Research at Chola Securities, joins us on the show. Hey Dharmesh, good morning. Good to see you in. Well, we've spoken plenty about tech from the morning because of this H1B visa issues that could hurt a lot of Indians. But let's keep that aside for now. Let's focus on other stocks. GST 2.0 is here with us, and it could drive a big consumption boost. And probably the next 1 month or 45 days or so is going to be very, very interesting because of a whole host of measures and GST 2.0 at the helm. Tell us, how do you approach autos, cement, some of those potential beneficiaries of the GST cut? I recall you telling us you're bullish on Hero MotoCorp as well as Mahindra & Mahindra in the past.
Yeah, very good morning, Nigel, and thanks for inviting me for the show. Now the time has come when the ruling will get going as far as the consumption drive is concerned. Government has did everything. I mean, whether it is GST cut, indirect tax cut, direct tax cut, and the interest rate cut, everything has been playing out. And there has been appeal by the government as well to boost up the consumption since savings are there in your pocket. So it has to be seen how the consumption pans out. But our dealer checks suggest across Pan India, there has been a good query and people have been inquiring about when this will be rolled out or how much the differential in the pricing will be. We think this is definitely, it will play out in the next 30-45 days. Though automobile stock prices have run up quite hard. I mean, Hero MotoCorp have run up 20-25% from the time we have discussed about this, and we have been bullish far earlier than that. Same has been the case with M&M. But I do think as incremental news flow with regard to sales picking up trickles down in, there would be momentum in the stocks and they will keep on riding higher. So 10-15% on the very aggressive side, upside can still be there, depending upon how the incremental sales are. And people who are invested, I mean, part profit taking is always recommended, but you can still continue the ride for another 5-10%. That is how we are looking at the automobile space, and the top two picks still remains Hero MotoCorp along with Mahindra & Mahindra. Though Eicher Motors, TVS Motor, Maruti, Tata Motors always is likely to see a good upswing. At the same time, cement side, as you have rightly pointed out, but I think there would be some tepid kind of action on the cement space, primarily because if you look at the cement prices net of discount, nothing has materially changed on that price. So the off-take price, the landed price for trade and non-trade sales still remains the same. Volume is what people are looking forward to, but that has to be seen. Again, 5-7% kind of an upside can still be there. And again, the top two picks, they are Ultratech and Ambuja Cement. We are looking at large cap cement companies having a pan-India presence and not going by the mid and small cap However, I mean, consolidation can still be there in the play. So that is how we are looking at consumption space. Not particularly bullish on the FMCG basket per se. I mean, how much you can consume, you cannot consume two toothpaste at the same time. So that is how we are looking at that space.
So Dharmesh, give us 2-3 stocks where you see a lot of upside. As you said, in the case of in the case of auto names, they've already done so well, and the upside could be what, 5-10%, and periodically you are recommending profit booking. So just 2-3 recommendations from you where one, there is still a lot of value left in the stock, and there could be meaningful upsides.
I think, Rima, I mean, one has to look at financials. But that is one space where rally has not picked up. And if we are buying the thesis that all this macroeconomic play, leads to consumption, longevity, and the drifting of the consumption into the month of November, December, then I think, I mean, 2-3 large cap stocks would be, one is from the private sector banking space. ICICI Bank and Axis Bank is looking solid to us. Similarly, from the public sector banking space, Bank of India. So these are from the banking space. NBFC, as Nigel pointed out, cement can pick up. So we are playing in the real estate scheme through, NBFC space or housing finance companies. There, I think PNB Housing Finance has taken a strong betting, and that was nothing fundamental to do with it. So business is continuing as usual. So that can be in the recurring along with LIC Housing Finance, Aadhaar Housing Finance, other three basket. So, I mean, the idea is go by a basket approach rather than a single stocks approach. And there a mix of, private banks along with, housing finance companies augurs well. As far as consumption pure play on the NBFC like Bajaj Finance and all is there, I think there won't be much traction out there. Much has been priced in. So there may be 2-3% kind of an upside, but then it's trickled down. But our long-term medium play definitely sits in the housing finance companies.
Yeah. Dharmesh, good morning. On Friday, there was that Supreme Court matter with regards to Vodafone Idea. And we got perspective from senior lawyers, etc., who told us that there is a change in stance, softening of stance from the government of India. This is now scheduled for the 26th of September now, where the government is expected to take a proposal to kind of sort of try to resolve this. We don't know what shape, form, etc. Vodafone Idea went up. Indus was up a little bit on Friday. Your thoughts?
Yeah, good morning, Bashar. I mean, this kind of rhetoric we have listened n number of times in the past 2-3 years, where government is, softening its stance, and they have already done their bit. They have done a lot of equity infusion, so it solely rests on the EGR part. If that has to be done away. Otherwise, on the operating level, if you look at Vodafone Idea, despite subscriber base getting reduced, they are doing fairly well on the operating profit front. And if some lease of life is given to them, then definitely the things are in place and they can consolidate and take it forward from there. But unless this comes through, the bleeding is excessive. Look at the kind of a debt which is setting out there. So just servicing of the interest component is unbearable. And at this point in time, if the bleeding continues for next 6 to 9 months, then I think nothing will be left to be undone. So we are hoping that things turn around. But unless something comes through, it's difficult to take a long-term investment bet. Trading bets based on news flows can always be there.
Dharmesh, what about Netweb? It's one of those few IT-related stocks which are close to its 52-week highs, I think 1% away. And its low in April was 1250, and now the stock is at 3200. That's a 160% jump. That's a kind of buying interest at lower levels. Now, I know the stock is expensive, but I was just looking at the growth numbers.
As of the most recent financial year, which is still underway given they follow October to a September accounting. And even from a percentage of the total H1B Visa approvals, that ratio for the top 5 companies has fallen from almost close to 11-12% to about less than 5% now. So the dependence for these companies has kept on reducing, and which has been a function of these companies hiring a lot more local resources, also sponsoring some of their existing workforce for green cards, as well as expanding nearshore presence in markets like Canada and Mexico. So I would say this is fairly a manageable risk, and with the clarity that came up over the weekend, I think becomes all the more manageable. From a set risk paribus, assuming that these companies continue to essentially apply for similar number of visas as they applied for in the last year on a continuing basis, and which is a big if given companies will change their operating model and also push some of this increase back to customers, something similar to what we had seen between CY 17 and 19. So if one or while that will like largely be the case, but assuming that they retain the same number of visas on an annual basis, the impact is probably higher for Tech Mahindra amongst the tier one companies. Tier two companies much more impacted compared to tier one companies, and BPO companies are completely insulated. So sorry for that long-winded answer, but I just wanted to set the context.
Did you speak to any investors who invest in technology names? Do they also concur that the impact is going to be limited? And if that is the case, is the dip any correction, a buying opportunity? And just one follow-up, how much downside from here on then for the IT stocks?
Sure. So I would say if there is a very sharp fall in the stocks today, probably that provides an opportunity to add on to these names. See, outside of the current visa-related challenges, the challenger that the Indian IT services sector essentially is facing is continuing moderation in terms of growth. And given the maturity and the fact that with the way macro essentially seems to be playing, there is concern now as to how CY26/FY27 plays out. So that's where we've had a very selective approach within the sector. So our preferred names are Infosys and Wipro amongst the tier one companies. The likes of Emphasis and Hexaware amongst the tier two names. And then in the BPO space, First Source and Sagility are our top picks.
You said Tech Mahindra is most impacted. Can you help with the numbers?
So as per our calculation, about 4% plus impact from an EBITDA standpoint for Tech Mahindra compared to probably tier one companies, which will be anywhere between 1.5% to 2%.
Okay, and how is this arrived at? I mean, how many people do they have on H1B Visa? How did you get this 4% EBITDA impact for Tech Mahindra?
So as of the most recent year, Tech Mahindra basically got almost 957 H1B approvals. This is a combination of initial plus continuing visas.
Okay.
And we basically arrived at essentially looking at a combination of the average 3-year approvals that these companies sought, and then assuming that they continue to essentially apply for a similar number of visas next year and 100K charge for that. Yes.
CLSA's note also talks about in the midcap space, LTI, Mindtree and Persistent having possibly seeing the maximum impact. Can you help with numbers here? Because Persistent, while they have clarified to the exchanges, they haven't shared how many H1B visas they sponsor, and therefore, like some of the peers like Sign, Emphasis have given actual numbers. So can you tell us for LTI, Mindtree and Persistent, and in the midcap space, would they be the ones most impacted?
So Persistent between in FY25 applied for almost close to about 192 approvals. This is as per the data that's there on the USCIS website. And LTI, Mindtree, I don't have the data offhand, but if you were to essentially extrapolate that for Persistent, the impact is close to about 7-8% on FY25 EBITDA if they retain that absolute number in terms of new applications next year. As I said, these are all significant ifs because companies will change their operating model, will probably apply for lesser number of visas. So assuming that essentially it's a 7 to 8% impact.
Okay, that's the gross impact pre-mitigation. These are the numbers that Manik has kindly shared for us. But of course, the companies have 6 months. This will be effective only next year for FY27 visas. So that's the timing angle. And the companies will look at increasing nearshoring, local talent, perhaps reduce the number of people they said, just send critical selective H1B visas. So the actual impact could be a lot lower.
Absolutely. Of course, there is, the problem is there more coming apart from this, right? Because, that higher act, which many are saying perhaps is low chance of passing, but there is another sort of, I think, proposal, increase the H1B sort of wages themselves. So is that going to basically adds to uncertainty, although earnings impact, as we've been pointing out, remains kind of mixed. All these IT stocks at the end of the pre-open session up at the bottom of the screen, they're down not very much. I mean, 1.5% to 2.5%, 3%. So in that range, Infy is down about 4% or so. And as I was pointing out earlier, this, of course, is the reason why I think the market is under a little bit of pressure as well. Sudarshan and Mitesh are back with us with their 9-10 calls. Sudarshan, what do you have?
Minda, Minda is a buy with a stop under 1300.
Okay, Mitesh, what about you?
Yeah, I'll go with the buy on Bharti Airtel for partnership 2000.
Okay, Uno Minda and Bharti are the two calls at 9:10 from Sudarshan and Mitesh respectively. Well, the standout brokerage report of the day, which one is it? Nimesh is standing by with that. Nimesh, good morning.
Hi, Prashant. So today's standout is an insurance sector. JP Morgan has upgraded a couple of names within that space. So they've upgraded HDFC Life to overweight from neutral, and target price sharply raised to 980 versus 750 earlier. And they've double upgraded GIC RE to an overweight from underweight, and there the target price is increased further sharply to 480 versus 197 earlier. So big upgrades on these two names from JP Morgan. LIC remains the top pick with an overweight rating, and a target price there is 1152. Now, JP Morgan expects the sector's compounding, the performance to the continue, and the balance sheet will strengthen further from here on. So that's the big call that they have. And on back of that, they expect the momentum to earnings momentum to continue as well. The very near-term trigger for the stock would be the GST-related new, new sets of policies which are going to get announced. So that could be a big trigger and a very near-term catalyst. But two big upgrades from JP Morgan today: HDFC Life to overweight, and a double upgrade on GIC RE as well.
Okay, all right. Thanks a lot for that, Nimesh. Well, let's hop across to Gaurav. He's here to tell us about Paytm. Morning, Gaurav.
Well, good morning. It seems like Jefferies is being a little bullish on Paytm because they have increased the target price to 1420. They recently met the management, and now what the management is saying is that payment platform has come a long way and it is also delivering profits now. They believe that the profit is going to increase. They have also indicated it earlier during the con call. Other than that, the management is also saying that the merchant franchise is very strong with around 45 million users so far, and it is the lending business is also going to increase and they are going to perform well. What they're saying is that there are new opportunities in the postpaid on UPI segment and wealth segment. Remember, recently they launched this postpaid on UPI service in collaboration with Suryodaya Small Finance Bank. So definitely they are also advancing in this field, and because of all these reasons, now Jefferies, they have raised their EBITDA target almost by 9 to 14%, which will be led by lower OPEX as per Jefferies. Definitely, when we talk about the stock performance in the last 6 months, we have seen stock delivering more than 50% returns from around 800 odd rupees to more than 1200 rupees. But recently, in the last trading session, we saw the stock decline almost by 4.5%. So given the target price of 1420, it leaves further upside of 20%. So definitely, it makes a case to watch how Paytm performs in coming days from here on.
Okay. Thanks very much, Gaurav, for that. Stock is up at about 1180 or so at this point in time. 90 points lower on the Nifty, about 475 lower on the Sensex. But let's just take a quick look at where else where else stocks are moving. Of course, IT we've been highlighting. They're all up on your screen, between 2 and 4% lower in Tech, Mahindra, TCS. Other stocks with news flow: Power Grid, Seagull, PNC, Infratech are all up on your screen. PNC is up about 3.5%. There's NBCC, which is in focus. Netweb, of course, has been a rocket. Stocks up 2, and Aarti Pharma is another one, which is flat. Garden Reach, Shipbuilders, Lupin, GNFC are some of the others, which we highlighted as a part of stocks with news, order wins, etc. So there you go. About a minute to go, less than a minute to go as far as market open is concerned. So we look at where things open up at, and then, of course, we will dive into individual stocks, etc. So it's a 70, 80, 90 point lower start. It's been that way from the morning, and we'll pick it up after that. So 25,240, it was a nice trending market higher. Friday, of course, we took a bit of a pause. Let's see if there is more here. 25,250 on the Nifty is where the Nifty is opening at. The Nifty Bank is not yet. I don't think we have the first rates here. Okay, I think we have 55,470. It's actually slightly in the green, if anything. Mid-cap index is down about 0.2. You've got the small cap index, which will come up on your screen as well. I'll give you a sense of where we're starting. 30 points, 35 points lower on the small cap. So I think the bulk of the impact coming via the IT services companies, and that's why the Nifty is down about 80 odd points. Other indices are doing better, if anything. The insurers are higher. Nimesh put out that call from JP Morgan. HDFC Life is coming up at one end. On the other hand, of course, you've got IT services, and the the Nifty heat map is kind of evenly split between how many stocks are higher and how many stocks are lower. Rima.
Well, it's IT all the way down. The losses, though, are limited to about 2 to 4-5% because, as analysts pointed out, the overall EPS impact is also going to be not more than 3-4%. And plus, companies have mitigating offsetting factors. But the top loser right now is Tech Mahindra. Analysts have been pointing out that Tech Mahindra is the most impacted in the large cap universe, tech universe. And that stock is down close to about 5%. And in the mid cap end of trade, it's, I think, persistent, where you are seeing considerable weakness. But the top 5 Nifty losers are all IT names. It's Tech Mahindra extending the losses now to 6%. TCS, Infosys, Wipro, HCL Tech also seeing cuts of close to about 3%. So that's taken a big knock today on expected lines. Autos too, a bit on the back foot. Seems like the GST bonanza, GST Reforms 2.0 has already played out. Stocks have done very well. So for today, Eicher Motors, Tata Motors are down close to about 0.5%. We should also pull up M&M and Bajaj Auto flat. It looks like, at least for now, things are on the quieter side. On the way up, it's life insurance, as Prashant was pointing out. HDFC Life is your top gainer. Adani Enterprises is one of the big movers. Here, there is a Jefferies note. They're bullish on the stock. Target price is 3,000 rupees. And Adani Enterprises is moving up quite well. Eternal is seeing buying. This month, it's seen a rally of nearly about 8%. In fact, many of the Adani Group stocks are continuing with the excitement from Friday after they got a clean sheet from SEBI. So Adani Ports too on the buying radar. But IT down, and the other stocks are not seeing big moves.
Well, that's right. A few stocks actually that are moving up. SCI, they have signed an MOU with BPCL, HPCL and IOC to jointly build and operate a fleet that strengthens India's shipping capacity and energy security under the Atmanirbhar Bharat Act. So that's why, in fact, that stock, in fact, is moving up on very, very large volumes. You have Garden Reach as well, that's up close to around 5%. Anandraj, I think Rima mentioned that stock is up and about in today's trading session. So big move is what we're seeing on all of those names. A quick word on the tech index. Well, it's still down close to around 3.5%. It's just recovered, I think, 100 points from the lows of the day. And, now it's 200 points recovery from the lows of the day. The low of the day is around 35,100. By the end of today, you'll want the tech index actually to recover considerable amount of this ground, which will tell you the kind of interest that you're seeing in the sector, because that's seen a bit of a run-up. Today, it's under the weather because of the H1B visa issues. But, let's see whether or not there can be some recovery. A few more stocks, you have Vodafone Idea, that's up close to around 1.5%. So it's seeing some kind of follow-through buying. Sagility is down 2.5%. Rima had mentioned that note on Swiggy. That as well is little under the weather. So the Nifty opens up in the red on expected lines. The problem today is that the tech index, well, that's giving no support whatsoever. The Nifty Bank, I think, is doing a relative outperformance if I get that one up for you on the screen. Let's see whether or not this dip gets bought into.
Such as the negativity surrounding, the sentiment has been hit. Even a company like First Source, which is clarified, they have zero impact, no H1 employees, on H1B Visa. Even that stock today has taken a hit of close to about 2%.
Absolutely. The index is down about 3% or so. So there is that pressure, which is very clearly showing up. The number one volume-led gainer on the NSE is Urban Company. Urban Company had a fantastic, last week, of course, it listed. It's only 4 days old in the market. Today is the 5th day. So opened at $160 and stocks now at about 190 rupees right now. I mean, I think it's not the 5th day, it's the 4th day in terms of the listed space. Listed on the 17th a few days ago. So 3.5%, very, very large volumes coming through, 191. Netweb is moving up 4% now. It's of course a new all-time high. As I was saying, I mean, it's up 25% this year. It's up a lot last year. I mean, of course, 2024 was the re-rating year in that sense, but the move is continuing. Silver Bs are up about 3% or so. I don't know if you can pull that up, but yeah, I mean, it's coming up. Silver, the ETF is also moving a little high. I'm not sure if there's a move as far as silver prices are concerned. On the downside, apart from the IT stocks, there isn't very much else. It's all IT, which is taking a knock right now. Mihir Vora is with us, Chief Investment Officer at Trust Mutual Fund. Mihir, great to have you with us here. Thank you for your time. So I guess first question is IT. What else? What do you think? Earnings impact, as we've heard from company after company and exchange releases, etc., seems to be minimal. But when uncertainty goes up, not just what's happened, but what may happen in the future, caps valuation multiples, doesn't it?
Yes, it does. And in any case, we've seen that the large cap ITs were not the fastest growing parts of the market in any case. So this certainly does not help sentiment. We have seen that there is some differentiation between companies which have less of H1B dependence versus companies which have a little more. But I think it's really, markets today reacting to the initial news. But in any case, if I were to take a 1 to 5 year call, then given the current business models, the large cap IT companies especially don't seem to be the fastest growing parts of the economy. I'd rather stay with the domestic themes.
So don't buy, even if you have a 2, 3, 5 year kind of horizon. Don't buy IT.
Absolutely, because the domestic and the segments in which the government is focusing on, like investments, consumption, etc., have a tailwind for them. Whereas in IT, you're only going to see incremental headwind. So while the US has clarified that the H1B program and the fees will not be on a retrospective basis, it does not apply to the existing stock of holders. But incrementally, obviously, it's going to be more expensive, and at $100,000, I think the H1B program pretty much becomes very, very selective and unviable for the normal kind of IT services that we were used to. Specialist roles, etc., will continue to happen, but that'll be a very minuscule portion. So obviously, the IT sector will face headwinds in its current business models unless they do things differently.
Well, indeed. Hi, Mir. Good morning, and good to see you, Ben. Tech seems to be going through its own share of problems. For the time being, though, there is some kind of recovery that we're seeing from the low point of the day, so we'll see how that one goes. Let's focus on the domestic themes then. Trump seems to have stole the thunder away from the GST 2.0. Let's talk about that. GST 2.0 goes into effect from today, and we could be bracing for the best possible consumption period. Possibly, the next 30 to 45 days could see a lot of buying. At least that's the hope. Consumption-related names as well as on autos. How much of this good news is in the price, and how would you approach these sectors?
Absolutely. The PM himself has said, go forth and buy stuff. So obviously that's going to create a good tailwind for the discretionary consumption segment. I think not only goods, but also services like airlines and hotels, etc. We are in for good times. And the fact that companies have done proactively a lot of pricing adjustments to at least create that buzz around the whole GST cut. So the timing was appropriate. We have the Navratri season and the festive season now starting for the next few months. So it should be good times for consumption. I think the sector has been quite underowned for quite some time. So while stocks have reacted and have gone up in the last 1 month or so, I think if you look at the portfolios of a lot of mutual funds and investors, there was a lot of underinvestment in the sector. So you might still see a lot of incremental money flowing into this segment.
Okay, all right. Mihir, what about, market construct itself? We have had our own set of headwinds, particularly in the last 12 months or so. Same time last year, the markets were extremely buoyant. Earnings growth was expected to pick up. We're talking about, even scaling higher from where we were at. Last 1 year, no returns. That's why retail's getting a little bit frustrated, because they're not used to this sort of a period after 4 very, very good years. So now the maturity of the investor will come into play. What is your approach with regard to the index? We are still holding strong, given the headwinds, whether it was geopolitical issues, whether it was with the lack of earnings growth, and the entire Trump saga that's played out. Do you think the markets can hold their own? The recent lows will be protected, the lows of this year, and the markets maybe see a time correction?
Well, we've already seen a time correction. As you mentioned that we've not made returns at the index level in the last 1 year. But the big issue is that we have to probably select which index we want to look at, because we were just talking about IT. That's the second largest segment in the Nifty 50, and the largest, of course, is banks and financials. In IT, there are headwinds as we just discussed. In banking, while everything is hunky-dory, valuations are cheap, we are still not seeing credit growth, which the hope is that it will happen for the second half. So IT, I'm not expecting to do much in the next 1 year or so. But banking, a lot depends on banking and the consumer part of the segment, apart from the traditional ones like government consumption, government investments, defense, etc., to drive the index. The good thing is that it was very lopsided for the last many years in favor of financials and banking as far as index returns are concerned. Now we'll have to depend a lot more on the other segments of for the index to work. So it's going to be, my guess is it's going to be a year in which stock picking will be more important than looking at the index levels.
Meir, let's focus on the metals pack then. There is hope that there can be a recovery from here on. The stocks, actually, to be fair, they have been the outperformers in the last 30 to 45 days because there is hope that China is getting its act together. There's going to be a lower amount of supply coming out of there, and we're bracing for some price increases in all probability post the monsoon. It's a tricky sector, but I've seen you in your earlier avatar as well. Sometimes you don't want to play the core metal plays. You look at some pipe makers. You look at other ways of playing the metal theme. How would you approach this space? Because clearly the government's measures, Chinese measures, and the Fed rate cuts, bode well for base metal prices. So your approach?
Base metals for me is always a tactical trade. So even if prices move up in the short term, they don't last, frankly speaking. In metals, the plays are more on the precious metals side, where unfortunately we don't have a lot of stocks to play with. It's mostly the ETFs which have direct exposure to commodity that we can play. But metals like steel, I would say, are more of a tactical play. There might be a structural rally in things like copper, but again, we don't have a real pure play, copper. While you might want to take a view on some of the metal stocks, it will be more tactical, and in the metals like gold, silver, copper itself that matter, we don't really have a direct play on the underlying.
And what about the pipe makers and the likes? Would you look at that? Because construction could pick up. So some of these pipe makers which have made no money whatsoever. There are the other suppliers with regard to the oil and gas space. Water could be in a bit of a headwind because we've heard about collection issues. But the hope is second half of the year will be better. So anything you like from that pack?
Absolutely. So the pipe makers have done well or expected to do well, irrespective of the metal prices. Though I wouldn't really play them for the metal price. But the fact is that given the buzz that we are seeing in construction activity and the continuing of government spending, etc., pipes in general should continue to do well, especially the ones which are more linked to real estate, because we do see that real estate construction in urban as well as in the rural areas should continue to do well.
Yeah, no, absolutely. And I think that's an important point.
And the other big one, and on the in pipes, the other big segment is, of course, in the structurals, which is linked to the government spending on infrastructure like your buildings, your airports, your railways, etc. Where again, I think given the state of the economy, the government is unlikely to let up on the spending on the infra part also. So I think the structural pipes, as well as the pipes used in your water for residential purposes, etc., should continue to do well.
No, those are important points. By the way, the market has recovered, right? The market is down only 40 points now, and it's come off nicely. The low today is 25,200, and we are at about 25,290 nearly. So that's the lift that the index has got. And the IT index is also recovered. It was down about almost 4% at one point. The low is 35,145, and we're at about 35,600. So, it's down 2.6% at this point in time. So coming up very, very nicely at this stage. Urban companies now up to 196. So about a 6% pop now on urban company. Any thoughts here? Mihir, urban company, did you participate in the anchor round or later since listing?
Well, I won't comment on individual stocks, but as of now, we don't have any holding in that particular name, and I would refrain from making a comment on the stock.
You like the business? Do you like the business, Mihir?
So in general, we like the scalable businesses, where the TAM is large. So you have some of the other ones. We have some of the other ones in good measure, like the delivery services, like some of the online ticketing services, online auction places, etc. So in general, we like the network effect kind of a space per se. And we have a good exposure to this segment, the new age B2B and B2C companies, yes.
Okay, thank you very much, Mihir, for joining in. Look forward to the next conversation. For now, let's kick off Corporate Radar. We've got Rakesh Sharma, Executive Director at Bajaj Auto, who's joining us as the new GST regime gets underway. Thank you very much for joining in. And some of the top discussion points today are, 1, the GST cut on bikes below 350cc, automakers passing on the GST benefits, and plus update on inquiries after the GST cuts. Thank you very much for joining in. First, on an average, can you tell us the reduction in prices on account of GST for Bajaj Auto? And over and above that, are there discounts? And how are the inquiries looking?
Good morning. Yes, it's a very important day today as, there's a lot of expectation in the market. The news has penetrated right across India from the urban and off late even in the rural areas. And there has been in the last 1 week a very healthy uptick for inquiries. And most people, particularly in the festive states, wait for the Navratris to begin so that they can take deliveries in the auspicious period. We have passed on, obviously, the entire GST reform and the entire GST cut. So in motorcycles, it ranges from, depending on the bike, from rupees 5,000 per unit to about 20,000. And three-wheelers too, we've passed on the entire GST benefit, which amounts to almost 28,000 rupees. We've gone further. There was an expectation that this little distortion which is there on the above 350cc bikes would get evened out, but when the announcement came, the 350cc's are being taxed at a higher rate. So we've gone further and we have maintained our prices of the 350cc plus range, just so that the consumer in the festive period doesn't see at least a disruption over there. In addition, as part of the festive spirit, we've made it attractive, particularly for those people who are going to take finance. And we believe that this cut should see better penetration of financing. So there is a little bit of, schemes on processing fees, etc., for customers who are going to be taking finance. So they will see an attractive offer over there. So all that combines to give a really healthy, 20,000 rupees saving for an average 150cc type of motorcycle.
Okay. And over and above the GST, the cut in prices on account of GST pass-through, are you giving any festive discounts?
Well, no discounts, like I just mentioned.
There are incentives if you take, for financing of the bike.
Yeah.
That is there. But other than that, no discounts?
No. There's no discount on the bike. I think there is a very healthy discount which the government has handed over to the customer. So I think that...
Mr. Sharma, how are the inquiries? Can you give us some numbers?
Well, it's very, very premature to give you numbers of inquiries, and I don't know how relevant that would be. But I can say that there have been a lot of calls and a lot of the visits. I would say that in terms of people calling, people visiting, there is a marked uptick in the last 1 week, gone up by 20-25%. So there is a lot of interest in the potential customers.
All right. Hi, Mr. Sharma. Morning and good to see you, Ben. So on a like-to-like basis, festival to festival season, what kind of numbers are you working with? Two-wheeler, motorcycles, as well as if you tell us in terms of EV. What is the rough growth you're looking at? Y'all are giving discounts. The government has given the set of discounts as well. So it should be very buoyant times, right? What is your estimate?
I think it should be buoyant times. I think most importantly, it will reverse the declining trend which the industry was facing. I mean, we just step back. FY25 ended at 6% growth. It started very well, did well in the festive, but Q3, Q4 of last financial year were negatives. Q1 was a negative. And year to date, that is April to August, the motorcycle industry was at -1%. And we were all expecting it to be around, between 3 to 5% plus. So I think that this reform is going to be quite a quite an inflection point, because it hopefully will reverse the negative year-to-date trend into a positive one as we go forward, not just in this season, but hopefully beyond the festive season in Q4 as well. Because some of the growth inhibitors which we were seeing in the last few months, which were around inflation, particularly rental inflation, and the reduction of disposable surplus, and the uncertainty around inflation, those forces will get mitigated. I think the customer sentiment will become much more positive when they see so many categories, the prices coming down. And that was a key reason. The financing companies were a little bit cautious. With disposable incomes going up, inflation coming down, I think they will feel a little bit better about risk assessment, and finance penetration should improve. So when you put this together, I think this will be quite a pivotal in reversing a negative trend into a positive one. But having said that, I was doing some maths, and we will still be below FY 18-19 in the industry. So there is some, FY 18-19 was the peak, and it will be a touch and go. But hopefully, let's see, fingers crossed, that we can cross the FY 18-19 peak by the time we close the year in March 26.
Mr. Sharma, hi, morning. Prashant here. Could you tell us, because your export proportion is also quite significant relative to other players, in the domestic two-wheeler segment, what's the sort of proportion of your sales which comes from the local market? And second, April to August this year, FY26, compared to those same months last year, there seems to be a bit of drop in market share for you, about roughly 90-100 basis points or so. I just want to go back to the point that Rima asked about other incentives, etc. What else could you do to, regain market share here? And if there are any specific reasons for this, is it intensifying competition in this segment? Go on, sir.
Well, to knock off your first question, the international business on volume terms is about 40-45%. Of course, during the festive, the domestic picks up. But over the year, the volumes are 40-45%. In value terms, it is about 45%. That's our share of our international business in the Bajaj Auto portfolio. Yes, from about 6 months or 9 months ago, we did start to see in certain segments a loss of market share. And a large part of that, I think, is competitive activity in terms of new product introductions by competition. And these have to be responded to. So that's very much in the cards, in the pipeline. Over the next few quarters, there will be a response on our strategic segment, which is the 125cc plus segment, with an array of new products coming in. If I rewind about 3 years back, we had the first mover advantage in terms of introducing new products into the freshly developing segment, which was the 125cc segment. So we raced ahead, and those products need refreshment. They need some more innovation, and that's about it. And that's what we are right now preparing for, and the next quarters should see that. I think that's the fundamental response, and all the other tactical stuff, of course, will accompany this fundamental action.
Okay. Sir, I think when, about a month back prior to this GST announcement, you had spoken about industry growth of 5 to 6%. Is that correct for domestic two-wheelers led by 125cc? Was that your...
That's right. That's what
so how will that number change now with this GST bonanza and an uptick in volumes?
So that's what I was saying in the beginning, that when the year started, all of us were expecting around 5 to 6% growth.
Correct.
because FY25 had closed at 6%, but slightly unexpectedly, for reasons of inflation, caution in the financing segment, we found that the industry actually degrew. And that is exactly what I said. But because of this change, the substantial benefit which the government has passed on to the customer, both in terms of both quantitatively and qualitatively, I think it will push the industry to reverse the negative trend and get a positive zone.
So 5 to 6% industry growth guidance stays now.
Hopefully, it should get back. There is no reason for the industry to now not at least go back to the last year's growth rate.
Got that. Thank you very much, sir, for joining in. We will slip into a break. On the other side, we'll connect with the managements of Metro Brands, PNB and Shriram Finance as the new GST 2.0 regime kicks in today. Stay tuned.
Given they follow October to a September accounting. And even from a percentage of the total H1B Visa approvals, that ratio still underway given they follow October to a September accounting. And even from a percentage of the total H1B Visa approvals, that ratio for the top 5 companies has fallen from almost close to 11-12% to about less than 5% now. So the dependence for these companies has kept on reducing, and which has been a function of these companies hiring a lot more local resources, also sponsoring some of their existing workforce for green cards, as well as expanding nearshore presence in markets like Canada and Mexico. So I would say this is fairly a manageable risk, and with the clarity that came up over the weekend, I think becomes all the more manageable. From a ceteris paribus, assuming that these companies continue to essentially apply for similar number of visas as they applied for in the last year on a continuing basis, and which is a big if, given companies will change their operating model and also push some of this increase back to customers, something similar to what we had seen between CY 17 and 19. So if one, or while that will like largely be the case, but assuming that they retain the same number of visas on an annual basis, the impact is probably higher for Tech Mahindra amongst the tier 1 companies. Tier 2 companies much more impacted compared to tier 1 companies, and BPO companies are completely insulated. So sorry for that long-winded answer, but I just wanted to set the context.
Did you speak to any investors who invest in technology names? Do they also concur that the impact is going to be limited? And if that is the case, is the dip any correction, a buying opportunity? And just one follow-up, how much downside from here on then for the IT stocks?
Sure. So I would say if there is a very sharp fall in the stocks today, probably that provides an opportunity to add on to these names. See, outside of the current visa-related challenges, the challenge that the Indian IT services sector essentially is facing is continuing moderation in terms of growth. And given the maturity and the fact that with the way macro essentially seems to be playing, there is concern now as to how CY26/FY27 plays out. So that's where we've had a very selective approach within the sector. So our preferred names are Infosys and Wipro amongst the tier 1 companies, the likes of Emphasis and Hexaware amongst the tier 2 names, and then in the BPO space, Firstsource and Sagility are our top picks.
You said Tech Mahindra is most impacted. Can you help with the numbers?
So as per our calculation, about 4% plus impact from an EBITDA standpoint for Tech Mahindra compared to probably tier 1 companies, which will be anywhere between 1.5% to 2%.
Okay, and how is this arrived at? I mean, how many people do they have on H1B Visa? How did you get this 4% EBITDA impact for Tech Mahindra?
So as of the most recent year, Tech Mahindra basically got almost 957 H1B approvals. This is a combination of initial plus continuing visas.
Okay.
And we basically arrived at is essentially looking at a combination of the average 3-year approvals that these companies sought, and then assuming that they continue to essentially apply for a similar number of visas next year, and 100K charge for that. Yes.
CLSA's note also talks about in the mid-cap space, LTI, Mindtree and Persistent. possibly seeing the maximum impact. Can you help with numbers here? Because Persistent, while they have clarified to the exchanges, they haven't shared how many H1B visas they sponsor, and therefore, like some of the peers like Sign, Emphasis have given actual numbers. So can you tell us for LTI, Mindtree and Persistent, and in the mid-cap space, would they be the ones most impacted?
So Persistent between in FY25 applied for almost close to about 192 approvals. This is as per the data that's there on the USCIS website. And LTI Mindtree, I don't have the data offhand, but if you one were to essentially extrapolate that for Persistent, the impact is close to about 7-8% on FY25 EBITDA if they retain that absolute number in terms of new applications next year. As I said, these are all significant ifs because companies will change their operating model, will probably apply for lesser number of visas. So assuming that essentially it's a 7 to 8% impact.
Okay, that's the gross impact pre-mitigation. These are the numbers that Manik has kindly shared for us. But of course, the companies have 6 months. This will be effective only next year for FY27 visas. So that's the timing angle. And the companies will look at increasing nearshoring, local talent, perhaps reduce the number of people they said, just send critical selective H1B visas. So the actual impact could be a lot lower.
Absolutely. Of course, there is, the problem is there more coming apart from this, right? Because, that higher act, which many are saying perhaps is a low chance of passing, but there is another sort of, I think, proposal, increase the H1B sort of wages themselves. So is that going to basically adds to uncertainty, although earnings impact, as we've been pointing out, remains kind of mixed. All these IT stocks at the end of the pre-open session up at the bottom of the screen, they're down not very much. I mean, 1.5% to 2.5%, 3%. So in that range, Infy is down about 4% or so. And as I was pointing out earlier, this, of course, is the reason why I think the market is under a little bit of pressure as well. Sudarshan and Mitesh are back with us with their 9-10 calls. Sudarshan, what do you have?
It's, Minda. Minda is a buy with a stop under 1300.
Okay, Mitesh, what about you?
Yeah, I'll go with the buy on Bharti Airtel for partnership 2000.
Okay, Uno Minda and Bharti are the two calls at 9-10 from Sudarshan and Mitesh respectively. Well, the standout brokerage report of the day, which one is it? Nimesh is standing by with that. Nimesh, good morning.
Hi, Prashant. So today's standout is an insurance sector. JP Morgan has upgraded a couple of names within that space. So they've upgraded HDFC Life to overweight from neutral, and target price sharply raised to 980 versus 750 earlier. And they've double upgraded GIC RE to an overweight from underweight, and there the target price is increased further sharply to 480 versus 197 earlier. So big upgrades on these two names from JP Morgan. LIC remains the top pick with an overweight rating, and a target price there is 1152. Now JP Morgan expects the sector's compounding, the performance to the continue, and the balance sheet will strengthen further from here on. So that's the big call that they have. And on back of that, they expect the momentum to earnings momentum to continue as well. The very near-term trigger for the stock would be the GST-related new, new sets of policies which are going to get announced. So that could be a big trigger and a very near-term catalyst. But two big upgrades from JP Morgan today: HDFC Life to overweight, and a double upgrade on GIC RE as well.
Okay, all right. Thanks a lot for that, Nimesh.
We've had a few muted quarters, there's no doubt about it. But if you look at our performance over FY19, we're up in the 100% range over FY19. So overall, we've slipped back a little bit from that 15% I guided to. However, we're confident that this kind of initiative gets us comfortably back into that 15% plus guidance for the long term.
Any intangible benefits, that you foresee with this lower GST coming into play?
I don't know about intangible, but I think another benefit is, as we go into end of season sale, right? There's a lot of products that might hit the 2,500 mark or might hit the 2,600 mark with the 20 or 30% discount we would give at the end of season sale. Now, all of a sudden, if you took it down to 25, it's no incremental discount to us as a retailer, but it's a benefit to the consumer. So, there are some advantages as we look into going forward, even going through the end of season sale period, which comes, at the end of this calendar year.
Got that. We'll leave it there. Thank you very much for joining us. And I think, if you're able to speak in about, 15 days, 20 days time, you'll have numbers, hard numbers, Mrs. Nissan.
That's right.
in terms of how things are panning out. But very useful. Appreciate it here on CNBC TV 18. Well, let's talk to two financial institutions. We're doing segments, but financial institutions are basically entities which are completely economy facing, and all of this will show up in terms of borrowing, right? Mr. Ashok Chandra is Managing Director and CEO of Punjab National Bank, one of the largest banks in the country. And we have Umesh Revankar with us as well, Executive Vice Chairman, Shriram Finance, one of the largest NBFCs in the country. Gentlemen, both of you, thank you very much for joining us. Prashant here. Mr. Chandra, let me. It's a broader question, but also a specific question. The GST impact and implications, right? Those are the three talking points. Of course, early signs of uptick in consumption, festive cheer, GST, of course, is something we will talk about with both, and of course, credit growth implications, right? So, Mr. Chandra, as I was saying, this is expected, the GST cuts, etc., are expected to show up in a big way, especially in the auto segment and also the consumption segments. Could you give us a sense of how you are thinking about it? What is PNB's exposure in these two categories specifically? Consumption loans, auto specifically? Just give us a sense, and what kind of uptick are you expecting?
Good morning. Yes, I think today is a very, very landmark day as far as the simplification and the rate cut in the GST, which is getting implemented from today. See, this entire rate cut which has happened, it is going to bring a lot of relief to everybody in the country now. And if I can talk about a specific field-wise, like agriculture, if I can talk, agriculture, PNB has a very good exposure. We have more than 1.3 trillion exposure. And the way the reform which has happened by way of rate cut in the agriculture, the different segments, agriculture equipments, tractors, the spare parts. So all those things are definitely it is going to bring good momentum in the agri sector. Farmers will be benefited, and a lot of relief is going to come to the rural development, the rural sector. So I'm going to see a good traction going to happen in the agri sector because of this simplification and the rate cut which has happened in the agri segment. If I can talk about the retail segment, again, that is a game changer going to happen in the retail segment because of two things. One is that the disposable income of the person is going to improve, and the demand for the consumer goods and the vehicles because of the rate cut has brought it in the system. I think all those things are going to pick up in a very, very big way from the today onwards. So I'm going to see a good traction happening in the retail front. If I can talk about the MSME part, again, there is a input relief is also there. And many of the MSME spare parts and the equipments, the machines, machineries, I think all the segment in the MSME segment, the segment also, sector also, are going to bring a lot of relief to the MSME people. And when the PNB is ready to provide all sorts of credit facility to all these segments, I think I'm going to see a lot of tractions happening in the agri, retail, and MSME in general.
Yeah, got that. In terms of credit growth, bump to credit growth, Mr. Chandra, would you like to put a number?
See, as of now, MSME segment is growing at a speed of around 18% in our bank. Q1 also we had 18 plus was the growth rate YOY. And as of now, when I'm talking to you, I think our growth is more than 18%. And with this simplification and the rate cut which has happened in the MSME segment, I think definitely 1 to 2% minimum growth I'm expecting in the long run. Retail segment also, especially the vehicle and the housing loan. Housing loan, again, if you see the cement sector, the cost has come down because of the lowering of the tax rate. I think again the cost of house dwellers also will come down, and definitely there will be a good demand for the housing segment also. So vehicle segment, I think a lot of things have happened. The one is the 28% to 18%. The rate reduction has happened in the overall vehicle space. Plus, if you say the spare part and the tires, all those rates have also been reduced. So I think going to be a big activity happening in the vehicle loan segment. I'm expecting that at least vehicle loan growth will be around 24 to 25% going forward. So I think 1 to 2% growth will happen in all the segment because of this GST simplification and the rate cut.
Got it. Good morning, gentlemen, and good to see you all in. Mr. Revankar, getting you into the conversation, but vehicle prices are likely to go down, right? Will there be enough uptick in volumes to offset this kind of price gap? What are your estimates?
Yeah, overall, there is the expected price drop. In fact, it translates into around 8% decrease in the price for the average vehicles. At the same time, I think manufacturers also are likely to give less discounts. Earlier, the discounts were high, and now the discounts will be lower. So, price to the customer, there may not be a big difference. There will still be some difference, but may not be significant. So, I feel overall it is a good sentiment, definitely yes. And during the festive period, when normally people buy new vehicle, I think there will be inducement for the customers to buy new vehicle. And for a long time, people have postponed buying a new vehicle because of steep increase in price in the last 3 years. I think this is a good opportunity for the people to buy a new vehicle and upgrade themselves.
Okay. So when we last spoke to you, Mr. Revankar, you said that this year, courtesy the GST bonanza, loan growth should be 17 to 18%, higher than 15% that you had earlier started the year with. Is that still on track?
Yeah, I said for this quarter, there will be a higher growth because it's a festive period. But whether it will keep the momentum for a long time, we are not very sure because there are other uncertainties like the US tariff that is still playing on and having some impact on certain MSME segments. So that we need to really see, and the real impact of that will be seen in the next quarter, because this quarter domestic demand will keep the momentum up. But from next quarter, we have to see how it will span out.
So for this quarter, what should be the loan growth that you see?
Yeah, this quarter we should be growing higher by 2 to 3% more than the previous quarter or previous year.
Got that. And in H2, the second half of the year, you're clearly seeing some headwinds, which could limit the growth on account of what's happening on the tariff front. Would you be able to explain that in greater detail about, what could be the actual impact on your numbers?
The impact to our number will be minimal. See, we will keep growing at around 15% as we guided in the beginning. That may not change much. But how much is the impact for the MSME and how government is going to support the MSME in different ways? The GST is one definitely a big step government has taken. But then maybe the industry may be expecting certain other measures like the subsidies on the interest rate or maybe reduction of the power tariff. Those things are there. There are some expectations which they are in dialogue with the government, which if it is possible, then MSME segment will keep moving and growing.
Mr. Revankar, we'll leave it there. Thank you very much for joining us. Mr. Chandra, appreciate you joining us here as well. Really, thank you both for your time this morning. I just want to quickly make a mention that the market's almost back in the green. So that's quite remarkable. 10 points lower, that's it. 25,300 is where the Nifty is at. And Urban Company now nearing 200 rupees. So that's something which we've highlighted. Still remains the number one volume led gainer. Started at about 191 and 198 now nearly. And Anantraj is back in the mix. Anantraj is up 5.5%. Huge volumes on Anantraj at 675 coming through here. And the other ones, Garden Reach and Netweb, etc., we've been highlighting. Look at Adani Green, which is picked up. Adani Total, Adani Green. So the Adani stocks are back in focus here. So these are the two names with large volumes. And Shalby Hospitals is at 264. It's up 10%. It's gone up like a rocket. So it's a big one coming through on Shalby. I can go down the list. Look at something like a Piccadilly. Piccadilly is at about 770 or so. That's a 6% move coming through. So lots of stuff, it's kind of sort of broadening out what we're seeing out there Piccadilly is the other one, apart from Shalby that we pointed out. Now, Union Home Minister Amit Shah, in an exclusive conversation with Network 18's Group Editor-in-Chief Rahul Joshi, said GST 2.0 reforms will be remembered as one of the greatest in history of the country. Some of the snippets of that conversation, let's just play them out.
जीएसटी के कारण 16 प्रकार के बिक्री से जुड़े सभी करों का, ऑक्ट्रॉय से लेकर बाकी सारी चीजों का, एक्साइज, सेल्स टैक्स, कई छोटे मोटे मनोरंजन कर था, ये सभी का एकीकृत खाका बना। पूरे देश भर की एक इलेक्ट्रॉनिक बिक्री कर प्रणाली बनी, ई-वे बिल बने, और जीएसटी के इतने सालों की यात्रा में 200 से ज्यादा छोटे मोटे बदलाव कर उसको लोकाभिमुख भी बनाया और टीथिंग प्रॉब्लम समाप्त भी की। ये करते 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 देश की इनकम भी बढ़ी और इतना बड़ा टैक्स का कटौती 80 साल में कभी नहीं हुआ है, जो अभी हुआ है। ढेर सारी चीजों में इस जीएसटी रिफॉर्म से फायदा होने वाला है। मैं मानता हूं ये बहुत बड़ा कदम है और इससे जनता का भरोसा बढ़ा है कि अगर हम टैक्स भरकर सरकार की नेट को बड़ा करते हैं तो सरकार टैक्स की कटौती कर फायदा जनता को ही पहुंचाएगी। और ये भरोसा आज़ादी से अब तक अदृश्य था, पहली बार वो दिखाई पड़ता है कि कोई भी सरकार अपने बढ़े हुए टैक्स को ये कहकर प्रोत्साहित करेगी कि भाई आप टैक्स भर रहे हो तो अब हम टैक्स कम करेंगे, तो ज़्यादा से ज़्यादा लोग टैक्स के नेट में भी आएंगे। मुझे विश्वास है इनकम भी कम नहीं होगी, इन्वेस्टमेंट बढ़ेगा, बाजार में एक प्रकार से तेजी भी आएगी और लोगों को सस्ता भी मिलेगा और यहाँ उत्पादन की गतिविधियां भी बढ़ेगी और देश की निकास भी बढ़ेगी।
Okay, that's an important opinion. By the way, Asia's firmly higher today. Nikkei is up over 1%. The Taiwanese markets, Korean markets are also moving up, moving quite smartly. So there is support coming in from Asia. We're dragged down by the cuts on IT, limited now to 2.5%, but that's been the big drag. Other than that, even the pharmaceutical index, the Nifty Pharma Index, is down about 3/4 of a percentage point. But holding flat now at the index level, Vinay Rajani, Senior Technical and Derivative Analyst at HDFC Securities, is now joining in. Vinay, your thoughts on the first 45 minutes of trade? What is the call for the day and your stock calls?
Yeah, good morning and thanks for having me on the show. So Nifty has absorbed the supply which has come in the early morning, and primary trend has been up. We have seen a correction of 230 points odd from the recent swing high of 25,448. But the primary trend has been up. Global market has been supporting. Broader market participation is going on. Sector rotation is fine. So overall, the sentiment is positive. Just because of the IT sector, it has opened gap down. Though we have been underperforming the most of the global markets and emerging market, but the primary trend and the way we have seen in last 8-10 sessions, Nifty has improved. I think overall trend is looking strong only. On Friday when we met, we discussed that there could be a possibility of running correction, and I suggested a support around 25,200 to 25,250 range. And today we saw that that range has been tested, and 25,211 was the low, and nice recovery has been registered after that since morning. So the trend is positive. I think rotation and the broader market participation will continue to do well, and one should remain bullish. 25,200 is a strong base. I think for the day it should not be broken, and overall sentiment should improve throughout the day from here. So overall I'm expecting resumption of an uptrend.
Vinay, what would you do in terms of specific stocks?
Yeah, so PSU banks have been doing quite well, and the technical setup is quite strong for the index, and from that Canara Bank looks very strong in continuation of an uptrend. So 118.9 should be the entry price. For traders, I would suggest a stop loss at 116. On the upside, I'm expecting a target of 123.50 in the short span of time. The second sector I would pick is the real estate sector. So after healthy correction, this sector has started showing some strength. So Godrej Property is one of the stock which has shown some reversal signs on the charts. So Godrej Property around 2145 one can go long. I would suggest a trading stop loss at 2105. On the upside, I'm expecting a target of 2205. So these both are recommendation for 1 or 2 days and with the mentioned stop losses.
By the way, the market, I think, is going to come into the green very soon. We're just about 5 points short, 25,320. So just the symbolism is outstanding, right? I mean, H1B, all hangama over the weekend and hand-wringing, anxiety, etc., and you've got the index, which is now the benchmark at least with 25,320, almost in the green from Friday's close.
Auto is moving up now.
Yeah.
It started flat, but now Bajaj Auto, Hero MotoCorp up more than 1%. So there is strength, and some of the banking names too are higher.
Well, we'll take a break. We are back. Manisha on the other side, commodities in focus in just a bit.
Welcome back. Let's shift our focus now to the commodity markets. Manisha is now joining in. Hi, good morning, Manisha. What are you tracking?
Thank you for that, Rima. Well, I'm looking at the crude oil prices because the last 2 weeks have seen some gains, and this week in Asia has also started on a positive note, as you can see, for the crude oil prices, more than 0.5% higher, and this is on the back of geopolitical tensions, the kind of statements that we've seen come in from Europe and also West Asia, for that matter. Well, to begin with, the Russian airstrikes on the West Ukrainian part now seem to be threatening the Polish border, and that is where the concerns are. The Polish, as a company or rather a country, also seems to be now trying to defend, also is moving its forces there, and that is what has led to some premium in prices. The second thing really is about the 4 Western nations over the weekend saying that they do recognize the Palestinian state, and this is even as US and Israel have been against it. Markets are watching out for the developments onto this one as well. The third thing is the European Union now proposing over the weekend a 19th sanctions package against Russia. What it also now includes is LNG exports. It also has nearly a huge number, really, 118 shadow vessels, some Chinese companies buying oils as well, and some other foreign companies also have found their name on this 19th package. Well, remember, European Union has been coming out with various packages, and we are looking at more addition into that. In addition to this, the European Union also says that going forward, they will stop buying LNG from Russia from 1st January 2027. Markets also looking at Iraq hiking exports to 3.3 million barrels per day. That is adding some supply pressure. This number is expected to increase to 3.45 to 3.5 as well going forward. And then, remember, this is the hurricane season at the Atlantic, and a second tropical storm, Gabrielle, has strengthened into a hurricane. The landfall is anticipated in the next 2 to 3 days, and if there is any disruption at all, we will see higher prices there. Remember, nearly 17% of Russian refining capacity is shut at this point in time, so any supply disruption will add further premium into prices going forward. I also want to take you through on what we've done in sense of crude oil prices till now in this year. We started firm at $75 a barrel for the Brent prices. We saw a high of $82 as well. We've seen $60 off a low as well into the markets, and to the lower side of the range is where we are trading right now at $67 a barrel. With everything that's happening in sense of geopolitics, Russia, Ukraine, tariff concerns, but it really has to do with the excess supply and concerns about demand. That seems to be keeping the prices in check. And this is about this year. But when you look at the prices itself, while we are down 10% for the crude prices in this year, it clearly is going to be a third straight year of declining crude prices the way we have been. It fell 3% in the previous year, and 12% of a decline is what we recorded in crude prices in 2023. So 25 clearly seems to be going the same way.
All right, Manisha, thank you very much for that. Well, we'll take a quick commercial break here. On the other side, it's our segments, the economy. Lata in conversation with Madhavi Arora of MK Global Financial Services and Mohandas Pai of RN Capital to discuss the impact of the H1B visa hike for IT services and the Indian economy in general. Stay tuned.
Welcome to It's the Economy. After a brief early dip, Indian markets in general and IT stocks in particular have recovered. The rupee too, while lower, is not the worst performing currency today. But two issues about the impact of the visa fee hike. Important one, impact appears to be more on Indians rather than Indian IT companies, given that US companies are hiring a lot more under H1B than Indian IT companies. Secondly, the hit may not be this year. It may be next year because this year's lottery is over. Now, given that the US is attacking India's goods and services exports, we need to watch the overall impact on India's current account, rupee, and indeed employment and economic growth itself. And to do exactly that, I have with me two stalwarts, Mohandas Pai, a veteran of the IT space, an investor, and of course now with RN Capital, and Madhvi Arora, the economist from MK Global. Mr. Pai, Madhvi, thank you very much for your time. Mr. Pai, is this a fair characterization? The impact is more on Indians seeking employment rather than Indian IT.
I think that's a very correct characterization, primarily because there are a lot more Indians applying for H1B than any nationality, and they belong to many more companies than the IT service industries. The IT service industries hire people locally, they build their development centers, they're insulated. And like you said, Lata, it doesn't apply for this year because this year the lottery is over. And I think they're going to issue visas. Applies for the next year. That means it will take one more year for people to apply and pay any fee. I'm sure the number of applications will go down drastically. The stock of H1B is not impacted as of now. The stock of H1B that is not impacted as of now. Okay. And the stock, if nobody tampers with it, will last for a long period of time. So my view is the impact will be very less. And also, Lata...
So, yeah, you know, Mr. Pai, Mr. Pai, I actually, you know, you're both an investor as well as someone who has been an insider of tech. How are you seeing this evolve? Will more be outsourced to, you know, eschew the H1B impact? And also because there aren't enough IT professionals or like, you know, similar talent people in the US. Do you see more getting outsourced at all? Is that the way we should take a positive read?
Lata, you saw the MIT study recently, right, about the use of AI in enterprises. How are global enterprises going to use AI? There's nobody but these IT service companies can help them. They have the framework, they have the vertical LLMs, they have the talent, they have the execution skills. So naturally, more work will move offshore. You know, Lata, after the COVID, we saw a surge in GCCs. What does it mean? It means the CTO of global enterprises understood your people don't have to be in front of you to keep your IP and do great things for you. They can be anywhere, right? You can work in New York and you can be in Dallas or Florida. Now you can be in Bombay, be in Bangalore or anywhere else. So they have shifted the GCCs, 1,750, 1,800 GCCs. So more work will shift offshore because the work is fungible. And the work is electronic and it can easily be done. The skills are here. There's nobody else. The US doesn't have the talent and people are not doing that kind of skills. And Lata, you're seeing the data too, that, you know, Indian companies pay the people in the US more than $100,000 for H1B, plus the cost of travel, plus the cost of leave, plus the cost of so many things. And I think this idea that they're all cheap labor is absurd.
Yes.
I think more work will move offshore and offshoring will improve. And I think there'll be a tremendous jump here. So on-site work will come down. That's my understanding.
Okay. Madhvi, what's your assessment on the macroeconomy? Until now, we were only looking at this 2% of GDP impact of the tariff on goods exports. Now a new can of worms has opened. Your assessment of the current account deficit and export growth this year, but more importantly, next year?
Lata, we have to see it in a broader perspective, firstly. You know, unfortunately, services now has been dragged in the trade war in some sense or the other. And the way US is now sort of telling the world that, you know, I want to be producer of services as well. So they largely have been consumers, right? So insofar, there was sort of being impacted only on the good side. Now, when they are sort of getting services on board, there are two ways I can sort of understand this bit. One is that US wants to essentially become a producer economy. Of course, it will come with a cost in the medium term. But at the same time, I think it is going to be used as a tactical way for the US to negotiate with India on the ongoing trade deals. That's the first macro impact for us. In terms of numbers, again, you know, you have to see it from 2 or 3 perspectives. You know, the 3 broad macro channels with which we'll have hit. One would be, of course, remittances. So our broad numbers suggest the remittance impact may not be too much. So the incremental potential H1B workers that would have gone to India, probably less than even 1 billion. So that's not a big concern for me. Of course, there could also be, increased offshoring, as you guys were mentioning earlier. So as of now, Indian companies largely maintain a 70-30 offshoring to onshoring ratio. In fact, and they've been very agile over the last 10-15 years. They've actually reduced their dependence on H1B visa. And even in the COVID period as well, they were able to sort of shift to offshoring very smoothly, and we saw the advent of GCC also coming our way. So the BOP impact from the lost remittances easily is going to be offset by, partially offset at least by increased services exports that we may see over the coming years. To be sure, that could also be replaced by nearshoring to countries like, say, Mexico or even in ASEAN countries. So we'll have to keep that also in mind. The third impact would be, of course, the outflow that we see from education-related remittances, which is outward remittances, which is basically, again, a modest number of around 6.5 billion, which is less than 0.15% of GDP. So that could get rerouted from the US elsewhere, or probably get reduced at the margin. But at this point in time, the BOP impact is pretty modest, in my view, in the near term. Of course, the medium-term implications could be severe for IT companies. But we've seen that in the past that IT companies have been pretty agile and very adaptive in terms of changing their growth model or changing their strategies, business strategies and stuff like that. And they also would have some time in hand, right? Next 6 to 9 months to prepare for this change that is going to hit their margins or revenue.
I actually am worried about the macro more than IT companies.
In the immediate run,
where almost it's agreed, and we have an insider telling us that it is marginal, like Mr. Pai. But Mr. Pai, I'm more, we are very, I guess we're talking about the medium term in slightly facile terms, because the terrain is shifting in weeks, not in months or years. So I'm worried about the Hire Act. That is clearly 25% tax if you export a service, if you do a GCC. And we've got some kind of a rehearsal in the way NVIDIA was treated. Okay, you export chips to China, but give me 15%. Should we be worried about such a change in terrain even for GCCs?
Datta, you are a brilliant economic observer, all right? Global industry, global enterprises work through structures of subsidiaries all around the world, right?
Yeah.
Apple keeps all its overseas profits in Ireland.
Absolutely.
All the global companies who outsource have their subsidiaries all over the world. What they will do is they'll ask the Indian companies to bill to the subsidiary because it gets consolidated into the US accounts, right? More than 50% of the business of Standard & Poor is outside. The source of revenue outside, which are accumulated, they're in tax-sheltered countries. So instead of billing to the US, you'll bill to Ireland, to the same subsidiary of the holding company. So where will there be a tax? The money will accumulate there. There'll be an income, there'll be an expense, and don't have to pay this tax. So structuring is very easy. So right now, I'm not very concerned about that. And remember, the US is has the net surplus in the services trade, $1.3 trillion deficit in goods, and maybe $700 trillion surplus in services. Now, if all countries start putting a 25% tax on the US services, they're going to get hit. India removed the Google tax, right?
Yes.
Just now to keep Trump happy. The Google tax will come back. After that, people don't care.
Yeah.
People will not care. You're putting so much, hurting us so badly. We'll also do that. And American tech companies will get hurt very, very badly. Yep. Like China kicked out NVIDIA right now. And China was a very huge market. So I think we've got to watch what will happen. My estimate is all the tech companies will go to Trump and work out a deal with him to say that without having H1B come in there, and they don't need this kind of a tax on services imports. And if they do, they're going to be in deep trouble. The US dominates the world in technology. If you look at the valuation of the top 10 digital companies, they make up a large part of S&P 500. And they're the drivers of the US economy in terms of capital investment this year, right? And I'm very sanguine about it. Let's wait and see. And you can expect the unexpected from President Trump. But I'm very sanguine that many of these IT companies will fight back.
very important takeaways, more as the accountants will outsmart the economists. And, we can have tax planning. Secondly, we must remember that others can hit back. I mean, the way in which EU and all countries have even declared Palestine as two states clearly show that they are willing to dare. You'll take this much and not further. So we could see that copybook play if the tax, tyranny goes too far. But Madhvi, aside from all this, yes, I do believe that even India has stood its ground in a very dignified manner. But would you worry that somewhere in the coming years, employment growth could be facing some at least near-term challenges because of this, stream of slings and arrows we are getting?
I agree, Latha, because, in the current year, it may not impact the revenues of IT companies, but it will start hitting them both on margin revenue from FY27 onward if this continues. Obviously, as I said, it's a signaling mechanism from the US that they want to localize a lot of this STEM employment. So that obviously will have impact on domestic market as well. But to some extent, as Sir was also mentioning, that there could be offsets that we may see in the medium term. The models could be very adaptive and agile, and we'll find ways and means to ensure that, companies find a way to remain profitable. But clearly, I think there are multiple factors in which, IT companies could get impacted. The demand environment in the US is also going to be difficult. There will be potential inflation in local and existing H1B holders as well as offshore shift, which may also lead to some, wage hit in India as well. So I think medium term, if the IT sector outlook remains a little less certain, obviously you will have impact in the organized economy, where IT segment is, a large chunk of the organized hiring space. So clearly that would be a big hit. And of course, they are the biggest source of services exports for us as well. Even if the GCCs at this point in time are growing in a much accelerated fashion, if there is a higher tax that come into our way, obviously I don't think that would be the case. But in a hypothetical situation also, if we assume that it would end up becoming a reality, I think then we are in a big fix in terms of, the services exports.
No, as Mr. Pai says, the world will always find a way to sidestep these.
Companies have been very adaptive. We have seen that IT companies have been very agile in terms of how they have been, able to sort of play with their models in terms of ensuring that, they remain profitable in the market. So I don't think that it would be.
Unfortunately, out of time, Madhvi. Mr. Pai, thank you very much. This is just the start of the conversation. I think we will have many more occasions. These arrows are not going to stop. And we will need your analysis constantly and your optimistic interpretation. Wrap up on Bazaar. Chartbusters coming up.
Benchmark indices recover from opening lows to trade near the flat line. The Nifty trades around the 25,300 odd mark, aided by metals, realty as well as financials. On the other hand, the tech space emerges as the top sectorial loser. The broader market trades in line with the key indices.
Shares of IT stocks trade under pressure and are the top losers on the Nifty after the Trump administration raises H1B Visa application fees to $1,000. TCS, Infosys, Telecom, amongst others, take a hit.
Consumption stocks rally as the new GST era gets underway. India Inc. also sounds optimistic. Bajaj Auto is expecting a strong festive season. Shoe retailer Metro Brands also expects good strong growth at around 15% CAGR post this GST rate cut.
And shipbuilders are in focus today. Garden Reach Shipbuilders rallies on a $62 million order. L&T, Mazgon Docks and Cochin Shipyard also trade with gains on reports of an 80,000 crore tender from the Indian Navy coming soon.
Netweb Technologies rallies 5%. This after it backs a 450 crore rupee order from Tyrone AI GPU systems. Hello and welcome to Chartbusters. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel, and with me today is Ekta. Hey Ekta, good to have you on the show. Well, the market started off in the red, but a good recovery is what we've seen from the low point of the day. And this keeping in mind that the tech space is actually under pressure. So pretty heartening start actually to trade today.
Hi, Nigel. Yes, absolutely. You know, if you just pull up the Nifty IT index on an intraday basis, there has been a recovery which has taken place there as well. So around 1% in terms of a recovery from the day's low for the Nifty IT index. And we have the Nifty, which is at around 25,317. So not as bad because we now do have the midcap index, which is just about broken into the green as well. So overall, the market seems to be a little more sanguine in terms of all of the bad news that took place over the weekend with regards to the H1B visas. And separately, we do have the GST rationalization or GST 2.0, which really kicks in from today. So that's the other big trigger to watch out for.
Well, that's right. Let's move to our first corporate conversation then. Mr. Mehul Monka, the Managing Director and the Group CEO of Tega Industries, joins us on the show. Hi, Mr. Monka. Thanks a lot for joining in. Well, we're coming across to you post the announcement with regard to all those that will be participating in your fundraise. We're coming to you in just a bit. For the time being, just highlighting the three broad focal points we're looking at: funding structure for Molycorp acquisition, the plans for unlocking synergies, and growth and capex plans for Molycorp as well as Tega. Mr. Monka, thanks a lot for joining in. Well, let's get a couple of details first out of the way. With regard to the company, this acquisition turning EPS accretive, you had mentioned it'll turn EPS accretive in the second or the third year. So will it turn EPS accretive in FY27 or is it a plan for FY28?
Morning, Nigel. Thank you for having me on the show. It's going to be EPS accretive from FY27 onwards.
Okay, all right. Got that clarity out of the way. Well, Mr. Monka, I'm not too sure about this data point, but I think this could be one of the largest fundraisers, via the preference route, could be in the top 5 as well, if you have some clarity on that front. And also tell us, what is the feedback you've got from your shareholders? Because you're looking to bite a big asset, but there are some that are a little bit nervous with regard to this sort of, of being so adventurous. Your feedback?
Yeah, so on the fundraise, I'm told that it's the largest in Indian capital markets through the preferential route. I don't have data points to confirm that, but that's what I've been told. I do understand, the shareholder, I would say, caution, but I would say that, we ourselves are looking at it, from an optimistic caution perspective, as one would say. We're excited about the opportunity. I think it builds great value for both the businesses put together. They're complementary in nature, and end of the day, we bring a lot of value to our customers globally.
Okay. So, Mr. Monka, just for your shareholders, if you could just reiterate how exactly would you be funding the acquisition? Because you have this preferential issue of around 2,000 odd crores. I understand that you have to, you will be funding via internal accruals as well. Can you just take us through the breakup of the funding of the acquisition?
Sure. So, from Tega's perspective, we need 3,300 crores in total to fund our 77% equity participation. We have 1,000 crores in terms of corporate debt already lined up as far as Tega is concerned. And we are to raise 2,300 in terms of equity raise for Tega, of which 2,000 we have confirmed participation as of now. And we're going to be doing another 300 crores of fundraise shortly.
This 300 crores will be to who?
We are going to do another fundraise of 300 crores.
So just break up this 300 crores. What kind of fundraise are you looking at? And by when? What is the timeline?
I think 300 is too small a chunk to do in QIP. So we'll probably do another preferential raise. We have to meet, we'll do it as soon as we complete the first one as per stock exchange guidelines.
Okay, got it. All right. And who is it going to be to?
We have a lot of interest currently already with a few institutions who missed out on the first one. So there still remains a few who are very excited about this transaction. So we will bring them in.
So expand a little bit on that in terms of the kind of interest that you've seen from what was the profile of the investors, and even for this incremental 300 crores who didn't get to participate and is looking to participate. Just take us through the details.
These are domestic institutions. I don't think I can reveal the names at this point, but we are in discussions as we speak. And there remains to be a strong interest to participate in the next round.
Well, that's right, Mr. Mohanka. I have my ear to the ground as well. And I believe that there was some strong interest. And some of those names didn't appear in the first list. So let's see whether or not they get into the second list. Got that. Now, let's focus on the business that you're taking over. One of the measures of cost saving is going to be relocation of the headquarters. Have you identified where's that headquarter going to be? And I think what you've guided for is around $7 million of savings. So tell us more.
Sure. So that's going to be somewhere in Asia. We haven't narrowed down on the exact city, but we are in discussions with the management team of Molycop for a particular location. It has to be something favorable from a time zone perspective because it's a global business. As well as, what we're attempting to do is find a city where there's, we can find one flight to anywhere in the world. So, yeah, that process is on, and I will confirm that shortly when we get to it.
Okay. You are expecting to unlock EBITDA level synergies of around $20 million by year 2 and $30 million per annum from year 4 onwards. Just tell us about this particular synergies. Where are you looking at in terms of synergies, and what would this mean in terms of consolidated blended margins for you all?
Sure. So these synergies are going to flow through from incremental revenue at Tega level as well as at Molycop level. So we have customers out in the marketplace who will benefit from participation from both the companies in the operational efficiency of the customer. So we're looking at these incremental cash flows to come through, or revenues to come through in both balance sheets of Molycop and Tega. And we're looking at close to about, I would say, in total, anywhere between $80 to $100 million of incremental cash flow to come through in the books of both the businesses to pay down debt.
Okay. All right. Final question then before we let you go, Mr. Mohanka. You're looking at increasing capacity on the high chrome side as well. And there has been that move from forged media to high chrome. Now, you're looking at increasing capacity. I think currently you're doing 20,000 and then 40,000 traded, so it's around 60,000, which you're looking to around 200,000. We have a peer that's listed, AIA, and they have said that, they find that they've seen some headwinds in this sort of a move, particularly on high chrome. What is your comment on that? How confident are you that you'll be able to achieve the guidance that you've given on this segment?
Well, I'm unable to comment on the views of my peers, but from our perspective, the way we're looking at it, I think there's been a lot of commentary that high chrome is gaining against forged media, but we don't believe that to be true. For us, we're coming out of a very small base. There are peers who are larger in the high chrome space globally compared to Molycop, but we are fairly convinced that high chrome is a good space to be in, and coming off a low base, I think the CAGR we're looking at about 15 to 20% over the next 3 years is much doable.
Execution will be key then on that front, because as I said, it's been a challenge for some of your peers. Final question, your revenue in the last year was around 1,600 crores approximately. Now, going by what all you have said, do you think the EBITDA number can nearly be double of your revenue, say in the next 4 years from now? Mathematically, it looks like the EBITDA number will be in excess of around 3,000 crores. Possible?
Absolutely. That's the reason why we're bringing these two businesses together.
Okay, just before we let you go, just a quick question with regards to the eventual debt that you would be comfortable with on Molycop's books, because you're saying that you have $1 billion, you'll go to 780 million from day one itself. But eventually, what's a comfort level that we're looking for in terms of the debt on Molycop's books?
So we won't like it to be anywhere higher than two times EBITDA at any given level. So the idea would be over the next 4 years to pare it down to those levels.
Okay, so at any given point in time, it shouldn't be more than 2 times EBITDA.
That will be the aim.
Okay, all right. We're going to leave it on that note. Thanks very much for joining in and speaking with us. So that is Tega Industries talking about their preferential issue of around 2,000 odd crores. They are planning a second preferential issue of around 300 odd crores, saying that interest has been quite significant there. We'll take a short break. We'll be talking to Ankur Rudra of JP Morgan from the JP Morgan 10th Annual India Conference. Stay tuned for that. Welcome back. You're still tuned into Chartbusters on CNBC TV 18. Well, we now have Ankur Rudra, who's the head APAC Telecom and India TMT research at JP Morgan, joining in to discuss his outlook on the IT space. Ankur, hi, welcome to the show. Well, I'm sure it was an extremely busy weekend for you, and you're probably working the phones throughout. So what is your sense in terms of, all the news with regards to H1B and even the clarification and net, the impact, according to you, on, say, frontline IT stocks?
Hi, thank you. Thank you for having me. So it's been, I think, the proclamation clearly on an overall basis prices out H1B visas as a source of labor for the industry on a prospective basis. I think what's been helpful is that it's been clarified, it applies only prospectively, and it's a one-time charge. So I think what we think is likely to happen is a lot of the enterprises and which outsource, and also the vendors themselves, will relook at their sourcing strategies to see if they can change the labor source. Increasingly, they've been depending on H1B visas less and less over the last 5-6 years. If they can further move towards local hiring, if they can also start using a lot more of nearshoring and offshoring. So we think that will happen to an extent to dilute the impact on a going forward basis. In terms of impact, it's very early days. Typically, when we have new changes, there are always some kind of litigation lawsuits against it. So there is some time for this to potentially impact. It's likely to impact the lottery year from next year onwards. But we think that across the board, around 20 to 50% of on-site employees for IT companies are probably impacted, and about 2 to 6% of earnings impact on an annualized basis from F27 to F30. But that's the worst case. We don't think the worst case will happen. Companies will change sourcing strategies.
All right, Ankur, good to have you on the show. The worst case unlikely to play out, and that's the hope. But, the tech space itself has underperformed, in the last 12 months or so, and gradually it was beginning to find favor yet again. Now, what's your view on the sector itself? Because growth could still remain very, very tepid. However, if you look at valuations, if you look at cash flow yields as well, they seem to be, turning a little bit favorable. So how are you placed?
Yes. So I think if you look at the overall IT services sector, there has been two sources of challenges. One is the macro, which has not been helpful thanks to the tariff and the trade uncertainty, which has been impacting demand. And second is potential deflation from an AI perspective, which is probably more medium term. In the short term, we would expect that the macro sort of headwind potentially eases away from calendar year 26 onwards. So this year is likely to be a weak year in any case. But the AI deflation probably plays out maybe for a 2 to 3 year base period and sort of goes away from the base. So when we look at the sector, we look at it in two angles. One is among the larger firms, which have become a lot more value, like you said. Free cash flow yields and dividend yields have become the cheapest they've been in the last 8 to 10 years, which provides a lot more value in sections of the large cap space which do pay out dividends. And on the mid cap side, there's some companies which are growing a lot faster, where these headwinds don't play out so much. So our approach is to have the value large caps which pay out dividends, which look attractive now, and some of the growth oriented mid-sized companies which can grow meaningfully faster from here on.
Ankur, Q1 actually stood out because there was some amount of revenue and margin deflation. As we get into Q2 and, just a couple of days before the quarter ends, what's your sense in terms of the trend that we could expect? Do you expect that sort of trend to continue into Q2?
Yeah, I think there are a couple of things here. One, overall demand environment probably will remain unchanged, in the sense that we will not see any further worsening or any meaningful improvement in the demand scenario. But from a bottom-up perspective, I think when we came into Q1, there was an element of negative surprise that demand was as weak as it was. I think in Q2, that negative surprise is unlikely to be there. And there's been a lot of larger contracts which have been signed on a cost-saving basis by a number of companies in the last 6-9 months. Some of them probably begin to ramp up. So we probably will see bottoming out of demand and growth being a bit more stable from here on. I don't expect things to meaningfully worsen. Having said all of that, signings might get impacted to an extent because of the visa-related uncertainty, but that will be more of a medium-term thing. From a revenue perspective, we think it will probably be similar to what we saw in 1Q, if not slightly better.
Okay.
Okay, Ankur, just turning attention a little bit away from tech, a quick comment on Telecom. Do you think that it's going to be a three-player market? And what are the ARPU increases you're working with? 26, 27?
Sure. So on the telecom side, we think that remains a 2.5-player market where the top two companies have invested very meaningfully and hence keep taking share to an extent. The third player is something that the government has indicated multiple times they want to do. So we'll have to see how that plays out. It will be a function of the solution on the AGR front. It's difficult to say at the moment. But our medium-term assumption is we'll have all the three players there. There'll probably be some sort of a solution. From an ARPU perspective, we have assumed a 10 to 15% kind of a tariff increase for the next couple of years. So around 10-ish% for fiscal 26 and around 10 to 15% for fiscal 27. So the change in view is earlier we had every 2 years there would be a tariff increase. Maybe now we might have a smaller tariff increase on an annual basis. That's what we baked in.
Okay, all right, Ankur, a short but effective chat. Wishing you all the best for the remainder of the conference and looking forward to chatting up with you as things do progress. Well, time to slip into a short break. On the other side, we'll focus more on markets as well as on stock-specific action. Stay with us.
Welcome back. You're still tuned into Chartbusters on CNBC TV 18. Well, as you can see on your screen, it is a good recovery that we've seen for our markets. We have the Nifty, which is just about flattened out. We have the Nifty Bank, which is holding up with a gain of around 0.2%. And like we've been pointing out, there has been some recovery which has taken place for the IT index as well. So it seems as though the markets are quite sanguine in terms of all of the bad news which has taken place over the weekend. But as you can see, the IT index is still under pressure, down around 2.8%. We have Infosys, TCS, HCL Tech, all of these frontline stocks which are under pressure today. But nonetheless, good recovery, Nigel, you'd have to say.
Well, that's right. The market's almost in the green. That's the Nifty, midcap index, even Stevens. Nifty Bank put its hand up and getting counted, while the tech space, we'll have to see what kind of a recovery we can see from these levels. But to be fair, from the lows of the day, it's recovered close to around 0.7%. We'll wrap up on this edition of Chartbusters. You stay with us. The team of Trading Hour is waiting by.
Good morning. We are right here bringing you a brand new edition of Trading Hour live from the CNBC TV 18 Motilal Oswal studios. Navratri greetings to all our viewers on the first day. I'm Hormus Fatakia with me, as always, Reema Tendulkar. Reema, good morning. Well, looking at how the IT stocks have reacted, you would take a 20-point fall on the Nifty with both hands, won't you?
Indeed. But you know, so many of the experts we've been speaking to since morning have said the EPS cuts are limited to 1 to 4%, assuming things continue as is. But companies will take mitigating steps. They will look to offset it by sending fewer H1B people or maybe increasing the local talent. So, I mean, the actual impact could be even lower. So I guess what we're seeing right now on the screen with respect to the IT stocks and the decline perhaps is what it's going to be. It's not going to be an existential crisis. But as you rightly pointed out, it's all about IT. IT is single-handedly dragging the indices down. Tech Mahindra is down 3.5%. Infi, TCS, Wipro, HCL Tech are seeing losses of close to about 2.5%. Mid-cap IT names, though, are taking a bigger knock. But that is because they've outperformed, and their ability to bear the H1B burden is a lot lower, especially if they are sending significant number of people abroad. So Hexaware told us that about 40% of the American workers are on H1B Visa, and that stock is down close to about 6% Emphasis, Persistent, Coforge too are seeing a downtick. But if you strip that out, it's not that the other sectors are losing significant ground. You've got, I think, the pharma index, which is mildly lower. The Nifty pharma index is under pressure. But outside of that, we are holding up pretty okay. So let's talk about stocks outside of IT. Hormus is now at the big wall, and he's going to put the spotlight on the top movers in the market. Hormus.
I had to put the spotlight on IT considering the fall that they have had this morning. And you take a look at the volumes as well. It's been on very significant volumes too. Now, Persistent, we've already had over 7 lakh shares that have changed hands. The 20-day average is just close to 1.5 lakh. Now, Tech Mahindra has seen the most significant volumes here. 25 lakh shares of Tech Mahindra have changed hands. The 20-day average here is just 3 lakh shares. Same is the case for Coforge, 11 lakh shares compared to a 20-day average of 4 lakh. And LTI Mindtree, with close to 2 lakh shares having changed hands, the 20-day average here is only 64,000. So a lot of these IT stocks are declining, yes, but also declining on very significant volumes compared to their 20-day average. The second one on the list today is a PSU name called State Trading Corporation, and here the stock is up 16%. This is the biggest single day gain and the most significant volumes that the stock has seen since July of last year. And you take a look at the volumes here as well. We have been highlighting this for quite a while now, that these broader market names, the moves that you're seeing are on extremely high volumes. And you take a look at the volumes here as well. 2.5 lakh shares have changed hands. The 20-day average is just over 3,000 shares. So compared to a 3,000 share average, over 2.5 lakh shares have changed hands. And courtesy of this move, the stock has broken above all of its key moving averages. Of course, mind you that the stock is having a very little free float in the market, considering the government owns 90% stake in the company, and of course, which is well above the minimum public shareholding norm. So keep that at the back of your radar. And lastly, the stock on the list is Shalby, and Shalby was up around 10-12% a few weeks earlier as well. It's up another 10% today. It's the third straight day of gains for the stock, during which the stock is up 16%. And take a look at the volumes here as well. Over 40 lakh shares have changed hands. The 20-day average here is only 2.5 lakh, so well over 20 times the 20-day average already within the first 2 hours of the trading session. And courtesy of this move, the stock has already gained more than 35% in the month of September. It has turned out to be the best month of the calendar year so far for Shalby, and as a result of which the stock has also turned positive on a year-to-date basis and also now trades above its IPO price.
Thank you very much for that. But today is the start of Navratri, and the GST 2.0 reforms kick in from today. We have with us Yashovardhan Sinha, CMD at Aditya Vision. Now, this is a company which sells a wide range of products. They include digital gadgets like your laptops, your mobile phones, home appliances like refrigerators, AC, entertainment solutions like televisions. They operate in more than 175 stores across India, but predominantly in Bihar, Jharkhand and Uttar Pradesh. And all the categories, and many of the categories that they sell in their stores have seen a marked cut in the GST rates, spurring price cuts. And the hope is that we will see a consumption boost. In fact, that is going to be the discussion, the points that we will discuss with the management. Sales expectations driven by GST cut, the festive season, the key demand trends across category, and the outlook on revenue growth and same-store sales growth. Thank you very much, Mr. Sinha, for joining in. I think that's the first question, right? Q1 was a bit subdued, but now expectations are running high. What were you anticipating at the beginning of the year in terms of an overall growth? What are you now expecting? And particularly for this festive season, what is the sales growth that you anticipate?
Good morning. Thank you very much for having me on your show. This big GST cut, I'll say, in fact, it is a revolutionary step from government. We expect that it is going to spur the demand like anything. In fact, it has just kicked in from today, and we are hoping and expecting to have a very good season ahead. In fact, such large cuts on air conditioners and larger TVs, etc., is going to see big boost for demand for these products, and we are hoping to have a very good season going ahead.
Can you put some numbers, sir, for this festive season, which runs from now to almost year end? What is the growth and full year growth?
We give our guidance of 20 to 25% in our guidance. And we are hoping to better this guidance this year because there is something new associated in this festive season.
Mr. Sinha, good morning. Thank you for joining in. Please complete your point, sir.
Sir, what I was saying, what we are expecting that with big cuts and with muted Q1, which we have seen, we are expecting a very good festive season going ahead. There are a lot of inquiries also. We are having a lot of bookings also. So these augurs well for our coming festive season first. Second, coupled with 125 unit free electricity has also a big catalyst in keeping the demand very high, and it is going to cheer up our customers. So these all in fact, I'll say that everything together is definitely going to do very well for the demand side.
So, Mr. Sinha, since you mentioned that there was a significant rise in inquiries as well after these rate reforms were announced, can you mention the categories in which you saw a significant spurt in inquiries, whether it was the air conditioners, whether it was television or other consumer durable appliances?
Yeah, of course. Wherever people were expecting a large cut in GST, the inquiries are very much there. I mean, ACs, which will be now taxed at 18%, they are very much in demand and very much people are were awaiting for today. So AC is one category. Second category will be larger screen televisions, where there is a huge cut in another 10% cut in taxes. So I think these two categories are going to do very well. And in fact, people are withholding their purchases also, which I think that with pent-up demand and coming season festive mood, I think these two categories are going to do very well.
Mr. Sinha, you spoke about how customers were withholding demand, waiting for the lower rates to kick in. Now, when we look at Q2, how was July, August, and even till yesterday when we had higher rates? I mean, was that as weak as Q1 or was there an improvement? I'm trying to understand pre-cuts.
I'll say that in fact, muted Q1 spilled over Q2 also because of incessant rains, as you must be aware. Yes. So it was a huge impact. It had some impact on our sales, but definitely from the day GST was announced, there was people were withholding their purchases. And though, of course, it was not very significant, but it was significant as far as growth is concerned.
So when you say muted till 15th of August, what are we looking at in terms of growth? And what about after?
Not 15th of August. In fact, when GST Council announced the entire decision, then only growth was. In fact, people started staying away from buying.
So what was Q2? Give us an indication. We're almost coming to the end of Q2, barring this last 10 days. How has Q2 been on an average?
So, as you know, this Q2 going forward from today, that will be a big part. In fact, maybe in next 8-9 days, we are going to cover a lot of lost ground, what we have lost in this month itself. So I think that we'll be covering up and recovering very well in Q2 in last 9 days.
So has this GST reform done anything to your store expansion plans? Considering how the first quarter was and the first half of the second quarter was, and now with the then and now factor, do you believe that you would be trying to go past that 200 store count by the end of the year?
Yes, we in fact, this is a very bullish news as far as our stores are concerned, and we are going all out for on this front. We hope to add. In fact, we have been adding more than 25 stores per year every year since last 3, 4, 5, 6 years. So we are in fact ramping up our capex, and we hope to open more, let's say more than 30 stores, but definitely will be about 200 store count by end of this financial year.
Okay. Sir, if I just broaden the time horizon and say 3 years down the line, what would be the 2 or 3 growth drivers for you? What is the opportunity that you're tapping?
We are, in fact, tapping on the opportunity that for the bigger, large population, we are in fact catering to. We'll be surprised that we are catering to almost 32% of entire India's population. And this population generally has remained under-penetrated all the time. So we think we find a very exciting market here, going to such places where nobody was there or it was still untapped. And overall penetration is so low, in fact, in all this region, that we hope that we are going to continue growing 30-35% over next near to medium term.
So with this anticipation, Mr. Sinha, one final question, sir. Does your store count over the next 3 years double from where it currently stands?
I hope so. In fact, everybody is aligned to this, and we are hoping, because all the store, whatever we are opening, they are giving us very good result. And in fact, we are looking towards newer, fresher areas, I'll say, still untapped areas. So I think, yes.
All right, Mr. Sinha, pleasure having you. Thank you so much for sparing time and joining us. Wish you good luck for the festive season and for the rest of the year as well. Aditya Vision there, hopeful that their store count would double over the next 3 years, and of course anticipating a significant recovery in this festive season compared to what the first quarter and the first half of the second quarter turned out to be. Take a short break. On the other side, put the spotlight on the crypto market. Manisha Gupta joins in.
CNBC TV 18 presents Crypto Corner, powered by CoinDCX.
Welcome back on Crypto Corner. Today we are talking about the asset class, which is crypto or technology, and on how to invest into this and what should you be really looking at as you do in various asset classes. But in case of crypto or virtual digital assets, what are the main points to keep in mind when we are looking at those investments? So the first on my radar really is about the market trend and prices. A lot of people get attracted into crypto because they've seen higher returns, they've seen prices run up as well. So in case of that, Bitcoin and Ethereum are your major things to watch out for, and this is what set really tones for the entire market there. So if you have these two cryptos surging up, the biggest is the Bitcoin and the second in sense of altcoin is Ethereum. That is when you know that the market really is surging on the higher side. There also are other popular altcoins like Solana, Cardano, Avalanche, etc. There's top 20, by the way, which you can keep an eye on. And if these are rising, that tells you that the overall market cap and the trend is on the higher side. The other point to watch out really is about the regulatory commitments there. Well, this is interesting because it really is about what stance, what country is taking will tell you on how the crypto as an asset class will move. So whether it's about regulations, bans, new crypto laws that are being globally launched is something that will lead the further direction. We've seen what is happening in US. We've seen how the legislations there have been changing. And apart from that, it can be about tax policies, KYC, AML rules that can impact prices and the market sentiment as well. The third thing to keep an eye on is about the technology and the protocol upgrades itself. You remember in the recent days, we've seen Ethereum continue to upgrade its layer 2 scaling solutions, so much so that we've seen improvement in transaction speed, cost, efficiency, etc. These things always work in favor of those coins which are ready to do hard work and improve technology. And then new consensus mechanisms, interoperability and sense of features, all of these are big positives. It also is about DeFi and
they follow October to a September accounting. And even from a percentage of the total H1B Visa approvals, that ratio for the top 5 companies has fallen from almost close to 11-12% to about less than 5% now. So the dependence for these companies has kept on reducing, and which has been a function of these companies hiring a lot more local resources, also sponsoring some of their existing workforce for green cards, as well as expanding nearshore presence in markets like Canada and Mexico. So I would say this is fairly a manageable risk, and with the clarity that came up over the weekend, I think becomes all the more manageable. From a set risk paribus, assuming that these companies continue to essentially apply for similar number of visas as they applied for in the last year on a continuing basis, and which is a big if, given companies will change their operating model and also push some of this increase back to customers, something similar to what we had seen between CY 17 and 19. So while that will like largely be the case, but assuming that they retain the same number of visas on an annual basis, the impact is probably higher for Tech Mahindra amongst the tier 1 companies. Tier 2 companies much more impacted compared to tier 1 companies, and BPO companies are completely insulated. So sorry for that long-winded answer, but I just wanted to set the context.
Did you speak to any investors who invest in technology names? Do they also concur that the impact is going to be limited? And if that is the case, is the dip any correction, a buying opportunity? And just one follow-up, how much downside from here on then for the IT stocks?
Sure. So I would say if there is a very sharp fall in the stocks today, probably that provides an opportunity to add on to these names. See, outside of the current visa-related challenges, the challenge that the Indian IT services sector essentially is facing is continuing moderation in terms of growth. And given the maturity and the fact that with the way macro essentially seems to be playing, there is concern now as to how CY26/FY27 plays out. So that's where we've had a very selective approach within the sector. So our preferred names are Infosys and Wipro amongst the tier 1 companies. The likes of Emphasis and Hexaware amongst the tier 2 names. And then in the BPO space, Firstsource and Sagility are our top picks.
You said Tech Mahindra is most impacted. Can you help with the numbers?
So as per our calculation, about 4% plus impact from an EBITDA standpoint for Tech Mahindra compared to probably tier 1 companies, which will be anywhere between 1.5% to 2%.
Okay, and how is this arrived at? I mean, how many people do they have on H1B Visa? How did you get this 4% EBITDA impact for Tech Mahindra?
So as of the most recent year, Tech Mahindra basically got almost 957 H1B approvals. This is a combination of initial plus continuing visas.
Okay.
And we basically arrived at essentially looking at a combination of the average 3-year approvals that these companies sought, and then assuming that they continue to essentially apply for a similar number of visas next year and 100K charge for that. Yes.
CLSA's note also talks about in the mid-cap space, LTI, Mindtree and Persistent having possibly seeing the maximum impact. Can you help with the numbers here? Because Persistent, while they have clarified to the exchanges, they haven't shared how many H1B visas they sponsor, and therefore, like some of the peers like Sign, Emphasis have given actual numbers. So can you tell us for LTI, Mindtree and Persistent, and in the mid-cap space, would they be the ones most impacted?
So Persistent between in FY25 applied for almost close to about 192 approvals. This is as per the data that's there on the USCIS website. And LTI, Mindtree, I don't have the data offhand, but if you were to essentially extrapolate that for Persistent, the impact is close to about 7-8% on FY25 EBITDA if they retain that absolute number in terms of new applications next year. As I said, these are all significant ifs because companies will change their operating model, will probably apply for lesser number of visas. So assuming that essentially it's a 7 to 8% impact.
Okay, that's the gross impact pre-mitigation. These are the numbers that Manik has kindly shared for us. But of course, the companies have 6 months. This will be effective only next year for FY27 visas. So that's the timing angle. And the companies will look at increasing nearshoring, local talent, perhaps reduce the number of people they said, just send critical selective H1B visas. So the actual impact could be a lot lower.
Absolutely. Of course, there is, the problem is there more coming apart from this, right? Because, that higher act, which many are saying perhaps is low chance of passing, but there is another sort of, I think, proposal, increase the H1B sort of wages themselves. So is that going to basically adds to uncertainty, although earnings impact, as we've been pointing out, remains kind of mixed. All these IT stocks at the end of the pre-open session up at the bottom of the screen, they're down not very much. I mean, 1.5% to 2.5%, 3%. So in that range, Infy is down about 4% or so. And as I was pointing out earlier, this, of course, is the reason why I think the market is under a little bit of pressure as well. Sudarshan and Mitesh are back with us with their 9-10 call. Sudarshan, what do you have?
It's, Minda. Minda is a buy with a stop under 1300.
Okay, Mitesh, what about you?
Yeah, I'll go with the buy on Bharti Airtel for 2,000.
Okay, Uno Minda and Bharti are the two calls at 9-10 from Sudarshan and Mitesh respectively. Well, the standout brokerage report of the day, which one is it? Nimesh is standing by with that. Nimesh, good morning.
Hi, Prashant. So today's standout is an insurance sector. JP Morgan has upgraded a couple of names within that space. So they've upgraded HDFC Life to overweight from neutral, and target price sharply raised to 980 versus 750 earlier. And they've double upgraded GIC RE to an overweight from underweight, and there the target price is increased further sharply to 480 versus 197 earlier. So big upgrades on these two names from JP Morgan. LIC remains the top pick with an overweight rating, and a target price there is 1152. Now JP Morgan expects the sector's compounding, the performance to the continue, and the balance sheet will strengthen further from here on. So that's the big call that they have. And on back of that, they expect the momentum to earnings momentum to continue as well. The very near-term trigger for the stock would be the GST-related new, new sets of policies which are going to get announced. So that could be a big trigger and a very near-term catalyst. But two big upgrades from JP Morgan today: HDFC Life to overweight, and a double upgrade on GIC RE as well.
Okay, all right. Thanks a lot for that, Nimesh. Well, let's hop across to Gaurav. He's here to tell us about Paytm. Morning, Gaurav.
Well, good morning. It seems like Jefferies is being a little bullish on Paytm because they have increased the target price to 1420. They recently met the management, and now what the management is saying is that payment platform has come a long way and it is also delivering profits now. They believe that the profit is going to increase. They have also indicated it earlier during the con call. Other than that, management is also saying that the merchant franchise is very strong with around 45 million users so far, and it is the lending business is also going to increase and they are going to perform well. What they're saying is that there are new opportunities in the postpaid on UPI segment and wealth segment. Remember, recently they launched this postpaid on UPI service in collaboration with Suryodaya Small Finance Bank. So definitely they are also advancing in this field. And because of all these reasons, now Jefferies, they have raised their EBITDA target almost by 9 to 14%, which will be led by lower OPEX as per Jefferies. Definitely, when we talk about the stock performance in the last 6 months, we have seen stock delivering more than 50% returns from around 800 odd rupees to more than 1200 rupees. But recently, in the last trading session, we saw the stock decline almost by 4.5%. So given the target price of 1420, it leaves further upside of 20%. So definitely, it makes a case to watch how Paytm performs in coming days from here on.
Okay. Thanks very much, Gaurav, for that. Stock is up at about 1180 or so at this point in time. 90 points lower on the Nifty, about 475 lower on the Sensex. But let's just take a quick look at where else where else stocks are moving. Of course, IT, we've been highlighting, they're all up on your screen, between 2 and 4% lower in fintech, Mahindra, TCS. Other stocks with news flow, Power Grid, Seagull, PNC, Infratech are all up on your screen. PNC is up about 3.5%. There's NBCC, which is in focus. Netweb, of course, has been a rocket. Stocks up 2, and Aarti Pharma is another one, which is flat. Garden REIT, Shipbuilders, Lupin, GNFC are some of the others, which we highlighted as a part of stocks with news, order wins, etc. So there you go. About a minute to go, less than a minute to go as far as market open is concerned. So we'll look at where things open up at, and then, of course, we will dive into individual stocks, etc. So it's a 70, 80, 90 point lower start. It's been that way from the morning, and we'll pick it up after that. So 25,240, it was a nice trending market higher. Friday, of course, we took a bit of a pause. Let's see if there is more here. 25,250 on the Nifty is where the Nifty is opening at. The Nifty Bank is not yet. I don't think we have the first rates here.